Okay, good evening everyone. We'll start in a few minutes. Actually, there is a network breakdown in and around the class. That is why I was not able to start at 4 p.m. So a network service provider, he mentioned the net is going to come around 4:30. That is why I maintained the buffer time and I said 5 p.m. I want everyone to join in quickly because I'm going to start off with derivatives first. Okay, so tell all your friends just join in quickly because we want to start some important topic first. So I want everyone to join in quickly. Tell all your friends to join in. The marathon has started. I want everyone to be very quick. Tell all your friends, everyone, very good evening. Gauri, Dipti, who all are there? Asha, Nikita, Miraki, Ujjwal, Bhavesh, and a lot more. Hemang, and then Shivendra is also there. Very good. Tell all your friends to join in quickly because we are going to start off with some important concepts and then we are going to go forward. Okay. So please, I want everyone to join in fast. I'll wait for 1 minute more. Am I audible clearly? Do let me know if there's any problem. Even in the visibility, do let me know please. Shamvi, yes, a very good evening. Everyone, a very good evening. Okay. Okay. I think we should start. Okay, it's already like 5:05. Okay. So, a very good evening to everyone. My name is CS Harshwardhan Gaikwad and I will be taking your SFM Marathon Part 2. The students who have joined in for the first time today, so it's a request, go and first of all watch the Marathon Part 1 and then come to this. Okay. If you want detailed explanation of all the topics, remember this is a marathon. So there are already videos uploaded on the YouTube channel for Forex, for this portfolio, for mutual funds. So I would request all of you, if you want some detailed thing, so please go out there. This is a marathon. So in this video, I'm going to cover like the concepts of the 3 chapters which are there on the screen right now and also the important questions. Okay. Now, please pay attention. The students who were there yesterday we completed your 2 big chapters. We just went through it. It was capital budgeting and portfolio management. But today we are going to start off with derivative. That is number 1. Then we are going to complete Forex and then we are going to complete mutual funds. Okay. Now a lot of students are in a dilemma that sir, mutual funds is very easy. It's okay. No, remember one thing. There are some tricky questions. Mutual funds will do it at the end. Okay. So first time we are going to devote, and that is for derivative. I want everybody to pay attention. Okay, there are some new concepts coming your way. Now, is everyone there? Let button, can we get good marks? Are this what are you asking? If you watch only, no, remember one thing here, please everybody pay attention. Okay, marathon is just brushing your concepts to give you more confidence. If you're only relying on marathon, then God is going to bless you. Okay. So remember one thing, please do your studies normally, regularly. If you want the finishing touch up, if you want your concepts to be revised, then this is a great platform. Okay. See, remember one thing, me at a regular classes also, we can stretch it for 2-3 months. Okay. 2 months at max. So we are covering this in what 2 to 3 hours. So you can just understand how much it will be. Okay. So please. Yes, and even the notes, a lot of people actually messaged me yesterday about the notes. Why I did not, obviously I will share the notes. It is not like that I don't want to share. I will share the notes, but give me today's timing so that I can send you one compilation itself. Because if I would have sent you the notes yesterday, again I would have to send you today. So that is why wait for today's marathon. Let me finish everything and then I'll send you the whole compilation. Okay, sounds good for everyone. Okay, now please pay attention. I want everybody. Okay, now you might have done derivatives first. Okay, now derivative, as the name suggests, see, remember one thing, I will go in the basic also, what is put option, what is call option and all, but before that, there is one big concept that I think all of you might be going on a very hard stage for this, and that is remember one thing. I am starting derivative with this one. Yes, I know it's very awkward because starting I have to do it with put option, call option, and the future value calculation and all, but I'll do it afterwards. First, remember one thing. There are a lot of questions asked in the examination on this concept, interest rate swap. Okay, now the students who are in a bit of dilemma, so how is this coming over here? See, derivative is nothing but what? It is a contract, okay, between two parties. The value of that contract depends on an underlying asset. Why it is called derivative? Because it derives its value from something else. That's why it's called derivative. Okay, derivatives are contract. Okay, now remember one thing. Derivatives, there are a lot of types. For example, your futures, your forwards, your options, and swap. So derivative, in derivative you have four options, four types. Okay, so one is your futures, then your forward, then your options, and your swaps. Okay, usually what everyone does, they will bang on these concepts. Okay, option, I hope everybody knows it, but this concept is left out. Swap nobody does. And in the, if you see the recent MTP, they have been asking question about swaps only. Okay, so we are going to start off with this only, interest rate swap. Please pay attention, everybody. Okay, acha, how many of you know interest rate swap? Give me in the comment section, please. How many of you know this thing? And how many of you want to take more? See, I have taken a lot of sums on this. Okay, so first of all, we'll understand one basic idea. Okay, I am going to explain you interest rate swap in a very, very easy manner. Okay, I mean, I can give you one guarantee. See, in the last question, only by looking at the question you can answer. Okay, that is my guarantee to all of you. But remember one thing, what is the meaning of interest rate swap? Please understand. First, understand the word swap. What is the meaning of swap? Please tell me. Simple English. What? Exchange. To swap. Okay, that is exchange, normal. Okay, I'll write here exchange. I'll write here exchange. Now, in the examination, the question they're asking is about floating interest rate and fixed interest rate. To put it in a very simple language, example, there is this company A Limited, okay, there is B Limited. A Limited wants a fixed interest loan. Everybody pay attention, okay, this is very important. B Limited wants floating interest. B Limited wants floating interest loan. Sir, we know what is fixed interest loan. You go to the bank, you ask for a loan, they'll give you, this is your rate of interest. But some companies, they don't want fixed interest. So they want floating interest. Do the loan float? No, not at all. Floating interest, the meaning of this is, it is fixed to a LIBOR and MIBOR. London interbank offer rate, which keeps on changing, and the Mumbai interbank offer rate. Okay, so these things you might have seen in your MTBs also. Okay, now your floating interest, see, fixed interest is very simple. For example, A Limited goes to the bank, and A Limited, let us say, goes to HDFC Bank. The HDFC Bank says, boss, the interest rate is 10%. Finish. End of discussion. But in case of floating rate, you know what these guys will tell you? That LIBOR plus 0.50%. So whatever might be the LIBOR keeps on changing. Plus 0.50, that is fixed. So this is your interest agreement with the bank. Okay, so fixed is you have to give it in any circumstances, but under floating, it keeps on changing. So it might be advantageous to you or disadvantageous. That remains on what? Your LIBOR and MIBOR. Okay, now pay attention. Let us say one thing, this A Limited is fed up. A Limited is telling, yaar, shit, we should have taken the loan on your floating interest. We don't want to pay fixed interest. And B Limited is thinking, why on earth are we taking floating rate of interest? We want fixed. This means what? These both the companies, they want to exchange their loans. B Limited wants fixed and A Limited wants floating. But sir, how are these two companies going to understand that they want this interest, then this loan. So remember one thing, there comes the work of an intermediary. There comes the work of an intermediary. What the intermediary? Very simple. It's a broker basically. If the broker knows that yes, this company wants this type of loan and this company wants this type of loan, the broker, the intermediary will bring both of these together and the broker will charge a commission. Has everyone understood by now? Has everyone understood by now? Acha, Manisha is saying it's confusing, so I left it. Oh, you don't have to leave it. It's very simple. It's very simple. That's why I'm taking this only first. Has everybody understood the story up till now? A limited wants the other loan and B limited wants the other loan. And how are these two coming together? By a broker. Has everyone understood? Yes or no? Yes or no? Fast. I want in the comment so that I can go forward. Okay. Has everyone understood the swap story? Yes or no? Up till now you have understood about what is going on. Okay. Now pay attention. Now pay attention. Okay. Whenever we see the question of interest rate swap, they will give you exactly what the company wants. And whenever you're calculating the advantage, pay attention. It is exactly the opposite. Now I'm telling the story again. Pay attention now. If A limited wants the floating rate of interest, pay attention. If A limited wants floating rate of interest, we will give floating, no problem. The advantage will be exactly opposite. What it wants, will not give that. We'll give the advantage to it. For example. Now, there's a question in front of you. Okay, we'll start the question. Everybody has to solve it. Don't leave this interest rate swap. Question number, please don't ignore the question number. Okay, so I'll give you a proper compilation. Companies A and B face the following interest rate. Okay. So there is this one company A, there is one more company B. Two companies are there. There is this US dollar and Canadian dollar. Okay, done. Floating rate, it is LIBOR plus 0.5% and you have the LIBOR plus 1%. Okay. Fixed rate is 5% and 6.5%. Okay, done. Now, what is the question asked? Assume that A wants to borrow US dollar at floating rate of interest. So basically A wants what? What is A's expectation? Floating rate of interest. It is given in the question. Okay. And B wants to borrow fixed rate. So I'll just write it over here. I'll just love this. Everybody pay attention. Okay. Don't write anything. Just wait. Let this question go in your head first. And then you start writing. Okay. See. So basically A and B. What does A want? Please tell me. A wants floating and B wants fixed. Okay. So I just wrote what is there in the question. Now, again, a financial institution, that is an intermediary, is planning to arrange a swap that requires 50 BPS. So I've written the full form also over there. It's called as basis point spread. Nothing rocket science. Just it's a simple points. Okay. I'll tell you what is the meaning of that. So there's one intermediary which requires how much? 50 points. Okay. 50 in currency and all. If the swap is equally attractive to A and B, what are the rates of interest will A and B end up paying? Okay, now these are the usual questions which come up in your examination. Now first, I have written only this much. Yeah? A wants floating and B wants fixed. Now remember one thing, there's a rule in interest rate swap. Whenever you are calculating the extra points, okay, the advantage or disadvantage, always compute by the opposite rule. Example. So if A wants floating, compute the advantage or disadvantage point opposite. Opposite matlab what? The fixed. Now remember one thing. A is here. Pay attention everybody. I hope it is visible. Acha, one sec. A is over here. Now if you see A's angle, how much A can take a loan? Remember one thing. I am computing advantage disadvantage points. Exactly opposite. Now A wants floating. I know that, but the advantage disadvantage points should come in opposite. So what is opposite? Fixed. So fixed, A can get a rate or row how much of 5%. If A goes there and asks for a fixed interest rate, तो उसको कितना मिलेगा? 5% interest rate. Now against that, B is getting how much? 6.5. So can I say something like this? A is at an advantageous position because A is getting the interest rate at 5%, as against B is getting at 6.5. So I'll write here A is getting an advantage of how much? 5 minus 6.5, that is how much? 1.5. 1.5. Is this clear? Now next. Now B wants fixed, but for computing advantage, disadvantage, we'll do the opposite. So what is that? Fluctuating. Now floating. Now remember one thing. B is getting LIBOR plus 1%. But he could have gotten what? LIBOR plus 0.5. That means this guy is paying extra over here. So this means what? What is the difference? Difference is minus 0.5. That's a disadvantage test B. A is in advantage position of 1.5 and B is in a negative position of 0.5. Has everyone understood this, or do you want me to repeat this again? Has everyone understood this 1.5 and 0.5, or do you want me to repeat it again? I'll wait for 1 minute, but if you're not understanding this, it makes no sense for me in going forward. I want everybody. Has everyone understood this concept? Has everyone understood this concept? If you want to repeat it again, I'll be very happy, because see, if nobody understood this, then it doesn't make any sense of going forward. Acha, repeat. Acha, I'll repeat again. See, we have ample of time, okay, so just relax. I'll tell again, no problem. Pay attention. A, B, in simple words I'll tell you now, okay. A wants floating, we will compare advantage, disadvantage in opposite, that is what fixed. Now, if A goes there and takes a loan of fixed, so he will get at 5%, very good. But as compared to that, see how much B is getting, 6.5. That means A is in a very advantageous position. 5 interest is where, 6.5 is where. How much is the advantage? 1.5 positive. Simple, very simple. Now B wants what? B wants a fixed rate of interest, advantage, disadvantage in opposite manner. The floating, how much is B getting in the floating one? He is getting LIBOR plus 1% and A is getting LIBOR plus 0.5%. Are Baba, so B is paying more. How much? It's a negative point. How much? Minus 0.5. Got it. Now this is okay. Now we have to compute the net. How much is net? So 1.5 minus 0.5, your net is how much? Net advantage is how much? Pay attention please. How much it is? 1. How much net advantage? It is 1. Okay. This is the figure which you want to get, 1. Now pay attention. Now what are they telling? See what they're telling. A financial institution is planning to arrange a swap and requires 50 basis spread. So out of this one advantage, boss, 0.50, what is 50 BPA? That is points, okay? So 0.50 is going to whom? The financial institution. How much is left of advantage? Only 0.50 is left. And this 0.50 will equally be attractive to whom? A and B. I'm repeating myself again. You had a net advantage. Both the companies, net advantage, they had 1%. But out of that 1.50 goes to whom? The broker. Now how much is left? 0.50. Now this 0.50 is equally distributed A and B. Okay. So 0.25 who will take? A will take, and 0.25 advantage who will take? B will take. Now here comes your final answer. Now pay attention. Now we have understood. We have done the calculation. We have also understood, boss, yes. The advantage of 0.25 to A and 0.25 to B. Now go in the question and see exactly what they want. Okay. Now don't do opposite over here. Now A wants a floating rate. Okay, no problem. How much is A is over here? How much is the floating rate? LIBOR plus 0.5. So will he get this interest loan at LIBOR plus 0.5? No, boss. He will get the extra advantage. Advantage of how much? 0.25. So what if we do is LIBOR plus 0.5? No, it will be 0.5 minus 0.25. So what is the final interest rate? 0.25% of for Mr. A company. And for B wants a fixed rate of interest, and the fixed rate of interest is 6.5. 6.5, but will he get 6.5 now? No, he'll get less than that. So 6.5 minus 0.25, its final rate of interest will be 6.25. That's the final answer. A is LIBOR plus 0.25 and B will get 6.25 interest rate because of the swap. Has everyone understood this? Yes or no? Please tell me first. No, one question you only have to do. This is only starting. Many of you might have understood, sir, because you're doing it for the first time. I'm expecting you already. That is why I'm getting this thing. Has everyone understood? Yes or no? Has everyone understood? Yes or no? Okay. Acha, perfectly understood. Now we'll do one thing. Now I'll understand that whether you have understood or not. Okay. Now, chalo. I hope you're writing it down. Now pay attention. Now pay attention. Now, just for your reference, try to do. This is your MTP question. This question number 31. There was some guy saying in the comment, sir is not taking what the MTP questions. I want to tell that person who is there in the comment that these all questions are MTP only. Okay. Even this is your MTP question only. Now, try to do it. Try to do it just by looking at the question. See, following information available for two firms. Okay, done. Firm A, firm B. Okay. Now, what is the firm A objective? What does firm A want? Firm A wants floating rate. Okay, we will give. We will give. What does B want? Fixed. Okay, no problem. No problem. They have given you information for fixed and floating. They always give that. Okay. Now, what is the point down? Explain how the two firms would enter into a swap transaction. Okay, to reduce their interest cost. If firm A does not want to pour more than LIBOR plus 0.35%, such a beautiful question this is. You know why? First of all, what is the difference between the earlier question and this question? There is no intermediary in this. Let us say these two firms know each other and they want to swap. So there is no one in between, but there is one condition in the question. What is that condition? If you read the last line, see what they are writing. Firm A does not want to pay more than LIBOR plus 0.35. Okay, so that is the cutoff. Okay, so now please tell me, can you start solving? Sir, could you please explain money market hedge? What's his name? Shikhar. I'll explain when I start Forex, but I'll tell you one more thing. My Forex video is already uploaded. And in that, I have taken money market hedge very properly. If you just go there also, you'll understand. But I'll explain today's video also. Okay, no problem. Okay, if you want, see in this, I'm not taken like very big sum because of time constraint. But if you want the Forex big sum, it is all there. I've taken all the tricky question which you guys leave for your studies. That is mentioned over here. Okay, anybody who can tell me the answer for this? Anyone? At least start solving. Start doing something. I guarantee. But you know what I think? Everybody has left interest rate swap. That is my gut feeling. You guys have left interest rate swap. Everyone, fast. I'll wait for 1 minute. Okay, then I'll start solving. Fast. Chalo. A, B. A wants floating. So what we will do, if A wants floating, we will give the opposite advantage. This advantage should be in the opposite. So that means fixed. So remember one thing. Now, fixed is 10% and B is 11%. So A is taking very cheaper. By how much percent? 1%. That is the advantage over here to A. I hope you're doing it in this fashion only. Yeah? Now, B, everybody answering, give me 1 second. Now, B wants fixed advantage, disadvantage in opposite. That means what? Floating. Remember one thing, B is LIBOR plus 1% and A is taking as LIBOR plus 0.75. So boss, this guy is at disadvantage. By how much? Minus 0.25. So what is your net? 0.75. Very good. Okay, that is your gain. Has everybody got 0.75? Very simple. But there is a very big twist in the question. Now remember one thing, sir, 0.75 advantage we got. But what to do after this? They have not given or they have not specified also. In the above question, they specified equal. That's why I distributed equal. That too after deducting what? The intermediary expenses. But there is nothing in the question. They have only mentioned one thing. That A does not want to pay more than LIBOR plus 0.35. So we'll do one thing. We'll do reverse calculation. If A does not want to pay more than LIBOR plus 0.35, this means what? That is the final deal that he has got. Now remember one thing. How much is B getting right now? It is LIBOR plus 1. One second. Where is B? B wants fixed. One second. Firm A does not want to give C. So they are paying how much? LIBOR plus 0.75, and they do not want to go beyond LIBOR plus 0.35. So can you please tell me how much difference is that? So 0.75 minus point how much? 35. That is 0.40. 0.40. So can I tell you one thing? Out of this 0.75 gain, are Baba, 0.40 already A has taken. A has already told you, boss, I want 0.40. How much is remaining? 0.35. 0.35 will go to whom? B. Now tell me one thing. B wants fixed interest rate, and how much is fixed? 11%. So 11 minus 0.35. Your answer is, final answer is 10.65% to B. Has everyone got this? Yes or no? So if you see very closely, they have already given what is the answer. A wants that much only, LIBOR plus 0.35. If he wants LIBOR plus 0.35, give it to him. Big deal. But how much is remaining? So you have got 0.75 ka gain. So what we have done is, so A had 0.75. He wants 0.35. I took the difference out of this. That difference I deducted from this. And the remaining, it will go to whom? B. That's your answer. Has everybody got it? Yes or no? This is important. Don't leave this. It's very simple. It's bonus questions. Yes or no? Has everybody got it? Please give me yes, no, yes, no. I want everybody to be active. Huh? Tell all your friends to come. Acha, there's one more question I've taken. Interest rate swap. Now you have to solve. Everybody should get dot answer. Okay? Nobody should get wrong. Has everyone done? Yes, Hemang, you're right. Bhavesh, you're right. Actually, everybody is right. Okay, come on. Chalo. Now. One more question, and I think you should answer this. Okay. Now I'll read it out. Company P Limited and Q Limited have been offered the following rate per annum on a 200 crore 5-year loan. Basic, confusing, of no use at all. The first line. Okay. Next, Company P Limited, Q Limited, fixed rate, floating rate. They have given it to you. Company P requires floating rate loan and Q requires fixed rate loan. You can write down in the book also. You are required to design a swap arrangement that will net a bank acting as intermediary at 0.5%. Now there's an intermediary in this, so give them 0.5 what they're asking, and be equally attractive to both the companies. Also find out the effective interest rate. The last what we do. Can you guys do it, please? I'll wait for 1 minute. Try to do it, everyone. If you do this question, this means interest rate swap is done. Let any question come, you will do it. Fast. Everybody, quick. Should I start solving? There's no answer in the comments. I want answers fast. But if you have understood the first two questions, this question you need to solve on your own right now. Shikhar Gupta answer is there. He's saying point. He's saying that 0.2 each is the advantage after 0.5, right? So we'll do it right now. We'll see whether he's right or wrong. Okay. Now P Limited. I'll just drop this, okay, so that it looks more legible. P and Q. Okay. Now P wants what? P wants floating. So advantage, disadvantage in the opposite that is fixed. So remember, this is 12. So 3.4. Obviously, this guy is in a very advantageous position. By how much? 1.4. Okay. Now Q wants what? Q wants fixed. Advantage is opposite, that is floating. That is 0.6, and this is what? 0.1. So obviously, what is this? See, remember one thing. Has everyone got the answer or what? Net again, Khadija has got 13.2, and that's the final answer or what? Shikhar Gupta is saying 145. Now this guy is in a very disadvantaged position because 0.6, 0.1 that guy is getting. So minus 0.5. What is the net? Net is 0.9. Has everybody got 0.9? Yes or no? Yeah, I think somebody has got. Who has got? Who has got? Shambi have got 0.9. Asha has got 0.9. Very good. Okay. Now tell me one thing. Out of this 0.9, out of this 0.9, 0.5, who is taking? Who is taking 0.5 home? The intermediary. How much is left? 0.4, 0.40, and 0.40 equally will be distributed to both of them. Finish. That means what? Somebody answered in the starting only. That means 0.20 and 0.20. Now tell me what are the effective rates. That is the final answer. You have done a very good job by calculating 0.20 and 0.20, but tell me at the final what is the answer. So see, P wants floating, we'll give them floating, no problem. How much is floating? MIBOR plus 0.1. So what a beautiful, tell me what is, I want, very good, I think Devesh has got it right. Yes, remember one thing, sir, MIBOR plus 0.1, 0.1 minus 0.20, how? So your answer will be, you know what, your answer will be MIBOR minus 0.1%. That's a final answer. And here, how much you'll get for this P? What's the number for Q? How much you'll get? 13.4 minus 0.20, and your answer will be 13.2%. Has everybody got this? Has everybody got this? Yes or no? Remember one thing, that was plus 0.1. But you have got a more advantage. That is why it will be MIBOR minus 0.1. And the other will be what? That is very straightforward. 13.2 will be your final answer. Has everybody got this? Yes or no? Or डर चला गया क्या? Don't get scared for interest. That's why I took this first. See, rest you will know what is there. I think nobody will be in such a position right now. If I ask you what is the meaning of call option, you will not know. But this everybody leaves out. Okay. So, has everyone got it? Yes, no? Now don't get scared for interest rate swap, or don't leave that question also in the examination. Please do go and solve it. Has everybody done? Yes, no, yes, no. Okay, okay, cool. Done. Okay. Now, everybody please pay attention for like 2 minutes, okay? Chalo. Now, should we start derivative? This is derivative only, but now we start the actual revision part, okay? Because I wanted to finish up this first interest rate swap, and now we'll go on with what? The derivative part, okay? Now, please pay attention, okay? I'll revise everything in a very few minutes, so you'll understand what is the meaning of that and all, okay? So, derivative. Acha, do you know what? In derivative, what all you have to do? What all you have to do in derivative? See, first thing, strategies. Pay attention. I'm telling you how you should study strategies. Now remember one thing, strategies, there are a lot, protective put, straddle, strangle, but pay attention. Had it been your descriptive paper, this was more important, strategies. Because they will tell you to draw the payoff graph table, the net payoff. Now, being a computerized paper, the chances of this coming is a bit minimal, okay? Second, valuation of futures, which is important. This is important, this is important. We'll take down, there are 3 formulas for this. I'll tell you what is that. Next, you know, there are a lot of models, binomial model, risk neutrality model, okay, for computing the value of what? Options. So, there is binomial model. I've taken the question now on this binomial model. And the most important, which is the question is there in your MTP also, that is Black and Scholes. See, do you know one thing? What does these models do? Binomial, risk neutrality, multimodal, Black and Scholes. These are there for computing what? For computing option call, the option premium. That is why it is there. For example, Black and Scholes model is used for what? For computing call option. Okay. Remember, there's one more thing. Put call parity. Very important. Put call parity. Is everyone getting this? So you did not get the notes on WhatsApp. Yes, dear, that is what I'm telling in the first place. You will get the notes by today night or by max in the morning. Why am I telling you? Obviously, I do not want to keep the notes. I'll get anyone who messages me, I'll give them the notes. The point is wait for some time, because let me compile everything and then I'll give the notes. Can we solve the sums? Arey Shikhar, remember one thing, in the question they give you very specifically, please solve by binomial model, please solve by risk neutral. Remember one thing, there is a difference in binomial and risk neutrality. In risk neutrality, we use probability. In binomial, we use two options. Share price goes this much, share price goes this much. So there's a difference in both. Whatever is given in the question, you need to solve it by that method only. Okay. So now, one thing is there. I want everybody, I don't know how many of you got this, but write down this. Valuation of futures. Valuation of futures. We are going to go on to the questions also, but afterwards, okay? First, I want this everything in your head, okay? Remember one thing, if they ask you valuation of futures, there are three types of formulas. I'm telling again, there are three types of formulas. Please draw this in your book. First one. Security not providing any cash income. Not providing any cash income. And I'll tell you one more good trick also. In every question, they'll ask you only continuously compounded. See, you have a lot of formulas in that, but 99.99% they'll ask you only one method. That is what? Continuously compounded. I'll tell you what is that. First of all, please draw this diagram first. Next, security providing cash income, and write down the last one. Security providing income as percentage yield. See, what happens is, if it comes in valuation of future, no, risk neutrality risky है, हाँ बराबर है, और risky चाहिए. Security not providing cash income, write only one formula. I'll just give you one formula for this, which you need to learn. If you know it, it's good, okay? If you do not know it, in all these three methods, I'm assuming one method only, that is continuously I'll write it here also, okay? Continuously compounded. They ask you this method only. I don't know how many of you, the ones who are from Pune region, the admit cards which you guys have been issued, by the institute, the centers are very far away. Even this time it has happened the same thing. I don't know about others, but for jitne bhi the students who are there in my academy, everybody has got very far centers. I mean, it is so far, it is like 2 hours. So it just happened with you also, what? With all of you? You got the exam centers very far away, what? Or it is very next to your house? We are, so mine too is 2 hours away. Who is this first GFX? You are not there yesterday, I believe. What's your name? You are from Pune, what? Future value is equal to S into exponential NR. That is the first formula. Please write down everybody. Next, replace S with S minus I. Same formula. And what is I? Present value of cash income. What is S minus I? Adjusted spot price. After this, I start with the question. So I'll tell you what is put and call, and then we'll start immediately, okay? And why am I taking this question? Because these questions have been asked a lot of time. Security providing, same. Future value is equal to S into E N R minus Y. Now pay attention, please. You know what is E stands for? E stands for exponential function. That is 2.7183. What is E value? What is E value? It is 2.7183. I don't know how many of you know the 12 times formula on the calculator, but that is not required now. You know why? Because in the examination, they are giving you everything. They're giving you what is the exponential value also. You only simply need to do multiply. Okay. Remember one thing. In the earlier question papers, they never used to give what? The exponential. So we need to calculate on the calculator, but not right now. They give you everything. You only need to know the formulas. So this formula, this one, this. See, remember also, what is the meaning of this? What is the meaning of this? See, if in the question they're giving there is a security which is providing cash income throughout the tenure, then you have to use this formula. If they're telling this is a security on which there is no dividend, there is no interest, then use this formula. If they are telling percentage of dividend, then use this formula. So that is a formula which you need to use for specific angles. Okay. Are we done now? The most important, which everybody is, waiting, and that is options. Now I want everybody to pay attention. Acha, who is this Mayur Satkur? 80 kilometers away. Oh my God. You better go there in that city only and you stay there only. Because if you travel 80 kilometers every day, you will drain out of your energy only. Bapre, 80 kilometers, who puts centers? I think you should, what you guys should do. You guys should, mail them and tell them what is happening. Because last time also this only happened. I don't know how many of you know this, but last time the centers were so far that they had been a protest also, I think. Even I had put up a video on that. But of no use. They did not change the centers at all. I think they had arranged bus transport, I believe. As far my knowledge goes, they had arranged bus transport service for the students that they'll pick it up from some centers, some locations. I think this time also they'll do the same thing only. Okay. But our job is to go and give paper. So that is what we are doing. Okay. Options. Simple. Call option. Call. There are so many people who get so confused in this, what? Call option and put option. Everybody pay attention. This is very, 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 very important. Okay. Call option and put option. Now, what is the meaning of call option, put option? Ekdam simple. Remember one thing. If you are expecting the markets to go up, listen my individual word, every word. If you are expecting the markets to go up, you will purchase a call option. Buyer, seller. Just draw this table in your book. That's it. You are done with options. If what did I tell? If you are expecting the markets to go up, you will buy a call option. So when you will get benefited if the market goes up. Let us say you buy a call option. Let us say the exercise price. There is a word, exercise price, also called as strike price. Let us say this is 60 rupees, your exercise price, and the market on the day of your exercise is 80 rupees. Will you exercise your option or will you lapse your option? If it's called, you will exercise your option. Why? Because the whole world will buy at what price? They will buy at 80 rupees. But you are very smart. You will buy at 60 rupees because you have already entered into a call option. So what is the meaning of this? Call option. What is the meaning of call option? The buyer of call option will only benefit if the market price goes up. That means you are bullish. Did you get this? Simple. Now, sir, one sec. So if you buy a call option, if the market falls down, then what? Then the will suffer loss. I didn't know, Baba. You are the buyer. You are the option holder. You have all the rights. If the market is going down, lapse the option. Do not do anything. Straight away go in the market and buy. Example. Pay attention. Exercise price was rupees 60. Example. Okay. If the market price is rupees 100, what will you do? If you have a call option, you will exercise. You will go to the other fellow. You will tell the other fellow, hey, come here. Give the share price for 60 rupees because I've already entered into contract with you. He has to give. There is no option only. But what if the price drops to 30 rupees? If the price is 30 rupees, what will you do? So you will go to that fellow or what? No, you will not show your face also. Why? Because there is a big loss over there. So in this case, you will lapse. You will lapse the option. You will say, you will just call him, hey Baba, I'm not coming, lapse it. Is it allowed? Yes, it is allowed. Because you are the owner, you are the buyer. In this case, what is going to happen? Are Baba, your only one loss is there, and that is premium. Why are you getting this right? Because of why? And that is the premium amount. Because you upfront pay the premium. So, if you are the buyer, pay attention. I'm telling you in a very simple language. If you are the buyer of any option, call option, put option, first thing what you have to do, you have to pay premium. You have to pay premium. If you are the buyer of any option, call, put, let it go. First thing what you have to do, you have to pay premium. Okay. Now, I was talking about this thing. Pay attention now. Buyer, right to buy. Write it down. Huh? Obligation to sell. Put option, right to sell, obligation to buy. What is the meaning of this? See, the buyer is getting what? The buyer is getting right. Why he is getting right? Arey Baba, because he is paying what? He is paying something known as premium. So I always ask my student this one question. So according to you, you only tell me, which number will be more in the market? There will be buyers or there will be sellers. What do you think? What do you think? What is Bhavesh telling? Can you please explain option? Arey Baba, Bhavesh, I'm explaining options. I'm not completed also. My question is, in the market, what will be more? Buyer or seller? What is your answer? What is your answer? Fast. The answer is seller. You might be wondering, so how seller? Because a buyer has so much right. He can elapse, he can exercise, so simple. No, Baba. Seller is very smart. Seller takes the money upfront. That is why there are a lot of sellers in the market as compared with the buyers. Okay. If you draw this chart, you will understand everything. Okay. No, what Shamvi, what Asha, no, you only answer wrong. Sellers are there because they will take the money and they will what? They will pool their position first. Okay, because if you're a seller, you will get the premium upfront. Okay, that is the point. Okay, so has seller any right? Can seller decide anything? Can seller think, no, I will lapse, I will exercise? No, Baba. Seller has no option only at all. Seller has to do all those things which the buyer decides, because buyer only has the right, seller has no right at all. See, what is the word which I have written over there? A seller is under obligation. See, he has no right at all. He is under an obligation to do whatever which the buyer is telling him. If you understood this, it is done. It is done. Okay. Now, one more thing, there's a variety of options in India, basically American option and European option. I don't know how many of you know this. American option, this might come for theory also. American option, we are starting questions in 2 minutes, pay attention. And European option. European option. So what is the meaning of this American, European? Remember, options expire on the last Thursday of every month. I think you know this, okay? Last Thursday of every month. American option can be exercised. It can be exercised at any time. Anytime you can exercise. But European option on expiry day. On expiry date. How to remember this? See, US people, they do anything. So remember like that only. See, American can exercise anytime. That is how you can just, keep it in your mind. And European only on the expiry date. Have you got this? Yes or no? Have you got this? Yes or no? Everybody. Now pay attention, please. Now pay attention, please, everybody. Now, we'll start off with the questions. We have already started off with this interest rate swap. But now we'll start off with the derivative questions. And while explaining, I'll explain you what is black and Scholes also. Okay? Not now. Sure. Now, see, you were very attentive yesterday, okay? Everybody was solving and all. Now, everybody on your screen, I am starting off with very simple questions. We started with interest rate swap. Now we are doing derivatives only, okay? Now, what is the first answer? Please tell me. Remember, there's one question which comes on margin account also. So an investor has bought 2000 shares for 90 per share. The initial margin is 50%. So broker is going to ask for some margin, obviously. Even you open a demat account, they will ask for some margin amount. The maintenance margin is 40%. What is maintenance margin? It is just as your reserve in your petrol, in your two-wheeler. If it goes below that, it will strike. You know, Baba, the petrol has gone below that. So you need to refill it back. Same way, the initial margin is 50%, but the reserve maintenance margin is only 40%. And the stock price came down to 70, gone. Additional funds put by the investors in margin account is how much? What is the answer? See, he got it for how much? 2000 into rupees 90. How much was this? 1,80,000. How much is the value now? This got down to 70. So 2000 into rupees 70. 1,40,000. Profit or loss? It is the big loss of how much? It is a loss of 40,000. Now tell me one thing. The question is how much money you should add back? The loss of 40. How much money you should add back? So will you only maintain your margin or will you put 50? And the answer is 50%. That is 20,000. Pay attention. There's a rule in this. There's a rule. If you are going less than the, see, remember, for example, pay attention. Imagine this is your demat account. Imagine this is your call for maintenance margin. This is your call for maintenance margin. Matlab, if it goes beyond this, you need to fill up the money. But the point is, let us say you get a loss which has gone beyond this. You get a loss which has gone beyond the level. So the broker calls you up. The broker is telling, sir, you need to fill up your demat account. The point is, how much will you fill? Will you only fill till maintenance or till initial margin? And remember one thing, and the answer is what? Initial margin. You will not only fill this gap. You will fill it total. That is initial margin. That is why your answer is 20,000, which is option number A. Has everyone understood this? Yes or no? Next question on your screen. So what was the first question? See, remember, every question is leading to a concept. I have chosen those questions which is the outcome of a concept. So what is the margin concept? If a broker is calling you up for the money, you never fill it till the maintenance. You have to fill it till the initial margin. That is what the concept is about. Okay. Question number next. The spot value of Nifty is 6,430. An investor bought a 2-month Nifty for 6,410 for a premium of 24. The option is dash. Now first of all, you need to understand. Alicia and Bhavesh. I didn't get what is no. You're watching live or you're watching recorded? What? I didn't get that only. Someone is saying yes. Alicia Varghese 40 is loss, then why 20? Are Baba, listen. Oh, everybody listen. This is your loss. But the question is about what? The question about margin account. How much margin you will keep in your account? See, if you go out there and open a demat account, there is a minimum balance required to be maintained by the demat account service provider. So how much is that? That is the question over here. So if you're in profit, your minimum balance is intact. There's no one touching over there. But if you go beyond that, the broker is coming you and telling you, please give me my money back because there's no one over here. So in that case, how much you will do? That is 50% and not the main. What is the meaning of in the money and out the money? What is in the money? In the money means there is profit. Out the money means there is loss. Okay. So tell me one thing. He has bought a call option. The spot value is 6,430. Investor bought a 2-month Nifty for 6,410 and the premium 24. Can you please tell me what is the answer? So he got it for 6,410 and now the price is 6430. This is in the money and out. It's a call option. And when will you exercise your call option? Only if the price goes up. The price is already got up. So this is in the money. Everybody got it? Simple. Next question. Let's see who calculates this. Shares of C Limited is traded at 1150. Okay. An investor is bullish about the market. He buys 2 1-month call option contract, and one contract is 100. He buys 2. Remember one thing, he's buying 2 options and one contract for 100 shares. That means how much he's buying? 200 shares. With a, what is strike price? Exercise price of 1195 at a premium of 35 per share. 3 months later, if the shares are selling at rupees 1240, what will be the net profit or loss of the investor on this position? Anyone with the answer? Anyone with the answer? Fast. First of all, understand one thing, which option he's buying. He's buying a call option. He's buying a call option. So what is going to be the answer? See, what is the exercise price? The exercise price is 1195. Simple. And what is the price afterwards? It is 1240. So first of all, please tell me whether he will exercise or not exercise. Yes, he is going to exercise. He will exercise. He will exercise. How much is the difference? 45 into 200. So basically, how much is the profit? Rupees 45. Rupees 45 per share. Per share. How much shares he has got? He has got 200 shares. So what is the total profit? 200 into rupees 45. How much is it? 9,000. 9,000. So tell me one thing. Is this your final answer? No. If you are the buyer of call option, you will pay premium also. How much you have paid? How much you have paid? See, 35 per share. 35 per share. So 200 into 35 is how much? 7,000 rupees. Less. Less. Premium paid. Less. Premium paid. How much? Rupees 7,000. So how much is the answer? 2,000. Answer is 2,000. This. Option D. Great. See, now these questions are coming. Which one? The valuation of futures. See, everyone needs to solve. And see, the institute is going to make your life a bit easier by giving this. By giving this. If this was not given, then boss, you should know the 12 times calculator about this. Okay, but they're giving, so it's completely fine. So what is this? Pay attention. A stock currently stands at 7,000. Okay, the risk-free interest rate is 8% per annum, continuously compounded. Continuously compounded. If you are writing the formula which I just gave like 10-15 minutes before, and the dividend yield on the index is 4%. Please tell me one thing. I just drew a diagram of 3 methods. One, security not providing cash income, security providing cash income, and third one was what? This dividend yield. What should be the future price of a 4-month contract? How can you solve this thing? Future value is equal to spot into E in R minus Y. I've just drawn this formula. Okay, I've just written this formula. Spot is how much? What is spot? 7,000. Okay. What is exponential? 2.7183. That we all know. N is how much? N is 4 divided by 12. How much is rate of interest? 8 minus 4. Okay. So can I say something like this? Exactly what is given over here. See, that is what we have written. 8 minus 4 into 4 upon 12. And the value is already given to you. You need to simply do into 7,000. That's your answer. So 7,000 into what? 1.013423. The answer is 7093. The answer is what? 1. First one. Okay? Simple. Sure. Next. Question 29. Even this is simple. 1.0618 into what? 60. 63.70. Very simple. Forget. Oh, what a beautiful question. What a question on your screen. Can anybody tell me what is the answer for this question? Can anybody tell me what is the answer for this question? Can anybody please tell me what is the answer for this question? Anyone? if you sell a call option on a share with a strike price of 375, market price of 360 and a premium of 21, what is the maximum loss on the expiry of this position? I want everybody to answer this question. It is such a good question. See, understand the basics now. If you have drawn the table, which I just drawn like 10 minutes before, the buyer and the seller, you'll get the answer to this question. See, listen. Now, first of all, they are writing sell. This means what? This means what? It is seller of call option. Seller of call option. Can a seller of call option take a decision? Suzanne Rose, your answer is right. Okay. And how 354? Dipti, your answer is wrong. See, listen, understand. See, don't ratta this. Understand the logic now, and everybody understand. Can seller of call option take a decision? I can exercise, I can lapse. Absolutely not. Only the buyer can take a decision. The seller has to say only yes or no to whatever the guy is telling the buyer. That is point number one. Now see how they have confused you. What is the strike price? What is the strike price? 375. And how much is the market price? 360. Okay. Now please tell me one thing. Please tell me one thing. If you are a seller of call option and I am the buyer of call option, remember one thing. What will I do? Whether I will exercise or I will lapse. Remember one thing. In this thing I will lapse. In this thing I will lapse. But see the question what they are answering. What is the maximum loss on the expiry of this position? Arey boss, I can have a big loss. You know why? Because if this price goes on decreasing, let us say 350, 340, 310, 300, 290, there is no limit for the loss. See what is going to happen? See what is going to happen? If the option is in the favor of the call option buyer, he is absolutely going to come here and ask, give me the money first, give me the money. So this means what? The maximum loss is unlimited. The maximum loss is unlimited for the seller of call option because he cannot do anything in that. Has everyone got this? Cool. Next question, everybody. This is a very good question. Very good question here. Chalo. Everybody ready for this question? I want everybody to be very active and everybody has to stay till the end. Okay. On 31st of August 18, the value of stock was 8,800. Okay, done. The risk-free interest rate is 8% per annum. Okay. The dividend yield, they have given you a lot of dividend yield. Okay. In the previous question, there was only one dividend yield. The duration of this contract is 4 months. Okay. And the interest is calculated continuously compounded. What did I tell you? They'll only put these questions only continuously compounded. You are required to calculate the future price of the contract deliverable on 31st of December 2018. That means what? 4 months ka. Okay. How to compute this? How will you answer this question? Okay. Now, can you please tell me one thing? They are written dividend yield. That means the third formula which I just mentioned you. So, what is the formula? Please tell me what is the formula? It is future value is equal to spot into E N R minus Y. You only need to simply put the figures in this. How? How much is spot? 8,800 into E. How much is N? N is how much? 4 upon 12. 4 upon 12. What is R? Rate of interest is how much? 8. And how much is the dividend? How much is the dividend? Sir, so many dividends are given. What to do? So, will we do average for this? Yes. But for how many months? Only 4 months. Only 4 months. That is what? 3 plus 4 plus 3 plus 3 is equal to how much? 3 plus 4 plus 3 plus 3 plus how much? 13. Divide by 4. That is 3.25 because it is given straight 4 months over here. Okay. So minus 3.25. How much you are getting? See. 8 minus 3.25 into 4 divided by 12. See, you will get the same figure which is there over here, which is mentioned over here. Which is mentioned over here. I know it's very simple. What you will do? See, at the end of the day, what you will think? You are thinking, I know. Sir, what you are calculating? So simple. If they are given the figures, just multiply 8,800 into how much? 1.01593, and the answer is how much? 8940. How much is the answer? 8940.18. Have you got this answer? Everybody, have you got this answer? 8940.18. Have you got this answer? 8940.18. Yes or no? Yes or no? First, 8940.18, that is the future value. Please drop it in the comment so that I can go forward. Please. Have you got 8940.18? See, remember one thing, dividend take only for 4 months, okay? Dipti has got the answer, Nikhil has got the answer. Very good. Okay. The next question on the screen is, pay attention please. The next question, see, the chances of this asking in the examination, वही ना सर, मैं कैसे, सर क्या, what is he writing? मन या कैसे करना है, सीधा मल्टीप्लाई करो. Exactly. So my point is what? अच्छा, one sec. अच्छा, see, remember one thing. If in the examination they do not give you this, then what will you do? Then you cannot multiply. You need to compute that figure. Okay? Does anyone know how to compute this figure? This. You want to try or what? Achha, we'll try. I know it will take 5-10 minutes more, but if worst case, you see, you know your institute, they can do anything with you. Okay? So if they do not give you this value, you will be not in a position to only multiply. You will need to compute it. Okay? So how to compute it? I'll show in 1 minute. Okay? Pay attention now. E is raised to what? 0.01583. This is what is the deal over here. So how to compute the answer for this? What is E? So E is basically 2.7183. Okay? And this will be like this. 0.01583. So do one thing. Take 2.7183, and by the way, if you're under this forgetting from where did I get E ka figure, that is by default 2.7183. Okay, so take 2.7183 on a calculator, press square root 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. You should get this figure, 1.000 something, 244. Then minus 1 into this figure, 0.0583 plus 1 is equal to, now into is equal to 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. You will get this answer. I don't know how you can see this, and that is exactly the answer which they have given. You will get the dot answer, that is 1.01593. This is how you can compute on your own also, okay, if they are not giving you. The answer is 1.0159. Acha, has everybody got it, or do you want to repeat what I just told you? Has everybody got this? Do you know this stuff? What we did right now? So we computed the figure which they are giving here, Okay. You can pause the video afterwards and then you can check. Okay. Pay attention now. Question number 23 on your screen. Pay attention. So this is the payoff graph table. This is the, sir, you all know. Very good. This is the net payoff. I think this is very, what do you call that? I don't think they'll ask you this, but worst case scenario. Okay. So the point is, there is a 3-month call option which carries a premium of 15, exercise price of 120, and a 3-month put option. Okay. So there's two things, carries a premium of 20 for strike price of 120. So 90 to 140, you have to just mention. Now see, why am I telling you why this is not possible in the examination right now? Because see, every student will draw something different, alright? And there will be specific answers over there, and there is no paper also. So on how will you draw this? That is why this thing is not there, but still I will solve it right now. Pay attention. So 90, 100, 110, 120, random figures. See what they are telling over here, take it from 90 to 140. So I'm just taking the random figures, okay? 120, then we have 130, and then you have 140, okay? So now, please tell me one thing. First, you have got the call option. So how much is the call option? What is the exercise price? The exercise price is 120 and this for 3 months. Okay, what is the premium? It is rupees 15. So tell me one thing. If the exercise price is 120 and the market price is 90, what will you do, Ray? You will lapse over here. You will lapse here also. You will lapse here also. Yeah, there is no difference at all. In 130 you will exercise for 140 also because the market price is shot up. Okay, how much the premium has paid? You paid 15 rupees. You have paid 15. Sorry, you got a gross payoff. First, I'll pay the gross payoff. This is the action taken by the buyer. Second is your gross payoff. How much is this? Nothing over here. Here it is how much? 10. And here it is how much? 20. Okay, next. What is happening? We want this only to come. We will rewind. There's a lot of comments over here. Gross pay. Next, premium 15. Why? Because you are the buyer. You need to pay the money also, right? And then last will be your net payoff. So 15. Here there will be -5. Here there will be how much? 5. Okay. This is how you can just put down if they ask you. Okay. We can do it for homework also for the seller of call option. Okay. This is the buyer of call option. Very simple. Okay. In seller you need to put plus, because that's the seller part. Next. Oh my God. Somebody was asking me about the binomial model. Pay attention. Now everybody please pay attention. There's a way of solving this. Everybody please pay attention. See, in derivative they'll ask you specific questions. What we have taken today, interest rate swap at the top, they will ask you. In every question there is an interest rate swap. Next, they'll ask you valuation of future, which is very easy, continuously compounded. Next, third, they'll ask you about this. That's the only thing they'll ask you. There's nothing more to ask only in this. So can ask you this, what is the value of this, and Black and Scholes model. I'm not taking put call parity, it's very simple. So you see it is S plus P minus C is equal to E. Whatever figure is missing, you can just find it out. But this is important, binomial model, okay? Now, pay attention, everybody. Read the question, please. Okay, consider a 2-year American call option with a strike price of 100 on a stock, the current price of which is also 100. Assume that there is one time period of 1 year, only one, okay? The stock can move up or down by equal percent or 20%. So I have taken this question for only 1 year to just tell you what is the concept. The risk-free interest rate is 6%. Okay. Using binomial option model, calculate the probability of price moving up and down. Also draw one-step binomial tree. Now remember one thing. This thing, I'll just do one thing for more. This was very easy. Now calculate the value of the option. Calculate the value of the option. Can you do this thing? See, there is two models. One is the binomial model and one is the risk neutrality. In the risk neutrality, there's probability, which is very simple. Now in this question, I just changed it. You have to compute the value of the option. How will you do it? Now remember one thing. In binomial, now the price is rupees how much? 100. It is 100 rupees. It can go up also, it can go down also. By how much? 20%. So this will be 120 and this will be 80. This is a way of solving. Now tell me one thing. If it is 120 and 80, what will you do, Ray? Will you exercise or will you lapse the first one? In this thing, see, to write your value of delta shares. Value of delta shares. So 120 delta and 80 delta. Delta means what? That is the number of shares you should buy to write a option. Next. Pay attention. Next, value of call option. What you will do in the first case scenario, please tell me. Your exercise price is also rupees 100 only. So if the price is 120, will you accept it? Yes, obviously you will exercise it. So minus 20, going up low. So you will exercise it. So how much 100 minus 120 is minus 20? This you will not exercise. And last is what? Value of your portfolio. See, you might have done in a very different manner also. Okay, it's completely fine. 120 delta minus 20 and this is 80 delta minus 0. Just solve this thing now. 120 delta minus 20 is equal to 80 delta. How much is delta? So it will be 40 delta is equal to 20 and delta is equal to 0.5. What is the meaning of 0.5? 0.5 represents the number of shares you should buy to sell, to write an option. Now see what I'll do. Now put that delta in that portfolio. So how much this will be? 120 into 0.5 minus 20. How much is this? 40. This will be 40 and your final answer will be, how much? Pay attention please. How much shares you have to buy? That is delta, that is 0.5. Now how much is the value per share? It is 100. So 100 into 0.5 is how much? Remember, this is the value of call option, okay? Delta is how much? 0.5 into 100, that is 50, minus call option premium, that is what we have to find out. So 50 minus C. So this 50 minus C into your interest rate is how much? How much is the interest rate? Your interest rate is how much? I think it is somewhere 6%. Yes, 6% it is. 1 plus 0.06 is equal to 40. Solve this equation and find out the value of C. Find out the value of C in this. 50 minus C into 1.06 is equal to 40. Please find out the value of this. Fifty into this is this minus 1.06C is equal to 40. 42.4 minus 40 is 2.4 is equal to 1.06C. 2.4 divided by 1.06. The answer for call option is 2.26. That is the value for this. This is value of what? Can we explain delta part again? Yes. See, I'll explain the whole sum again. Please pay attention. If they are asking you solve by binomial, then not, see, I changed the question. They're not asking you, see, they were asking you probability, but that is very simple. So if they're asking you what is the value of call option, by using the binomial model, you need to solve in this fashion only. So first what you will do is present price, that this is the exercise price. It can go two ways, 120 also and 20 also, 20% up and down. Then value of delta, just put delta over there, 120 delta, 80 delta, finish. Next, value of call option. So which option, which point you will exercise? The first one. Why? Because the price has risen. So 100 minus 120 is how much? Minus 20. In a flow I have written here, you will not exercise anything. Next, value of portfolio. Simple, go in one line only. Go in one line. What is this line? 120 delta minus 20 I have written. 80 delta minus 0 I have written. Just solve this equation. How much you will get? You get delta 0.5. So what is 0.5? The number of shares you should buy for every call option written. WRITTEN. That is how many call options you have sold. For that, how many shares you have to buy. That is the meaning of delta. Okay. Now after that, I put the delta value in the value of portfolio. Then I found out this 40. I put in this. The first one, I got 40, and next is what? You have to compute the value of C. How will you compute this much? So, how much is per share? 100 rupees. How many shares you have to buy? 0.5. So, 0.5 into 100 rupees, how much? 50. How much option premium you have to, because it's called option buying. So, minus C. This is the value which we have to compute. So 50 minus C, if I invest in like risk-free rate, how much it will be after the point? It will be 40. This is the value of portfolio which I've already computed over here. And next you will get C is 2.26. This is the value of call option. This is the value of call option. Are you getting 12.36 or what? One sec. I'll solve it. One sec. But I did some calculation mistake or what? 40, 1.06 minus 50. Sorry, my bad. C is 12.26. 12.26, my bad. 12.26, right. 12.26 is right. 12.26, very good. Okay. Now pay attention. Pay attention, please. There is one more valuation model, and that is Black and Scholes. Black and Scholes. Okay. Pay attention. What is that? 12.26 is right. Okay. Now please, Black and Scholes model. I don't know how many of you done this, but please write the formula, and there is a way of solving Black and Scholes model. Okay. First of all, write down some things about Black and Scholes. Black and Scholes model. They will ask in the examination. First point. Used for computing call option only. It is used for computing only call option. Sir, if they are asking put option, then use put call parity. S plus P minus C is equal to present value of E. Not this. Okay. If asked for put option, use put call parity. Use put call parity. And the main point is, what is the formula for Black and Scholes? Very important. Write down. So it is CO, that is European call option, SND1. Do not leave this. This is very important. SND1 minus E into E minus RFT ND2. SND1 minus E into E RFT ND2. Now what is S? S is equal to spot price. S is equal to spot price. E is equal to your exercise price. Exercise price. ND1. Remember one thing. This N is nothing but what? That is the nominal distribution. Pay attention, please. So the point is, they already give you everything. Now there is a way of calculating D1 also. So please write down that first. How to compute D1? How to compute D1? So D1 is computed logarithm of S upon E. Trust me, this is simple. The only thing is it looks very big. Okay. Write the formula for 2-3 times. It is very, very simple. Spot upon exercise plus RF plus standard deviation square upon 2 into T, that is time to expiration, whole divided by standard deviation under root T. Please write this. Do not leave. That is an MTP question only. So that's it. Remember one thing. This is the formula. One sec. This is the formula, right? But in that two values are there. There is D1 also, there is D2 also. So pay attention now. D2 is how much? What is D2? It is D1 minus this. So D1 you will find out, and how to find out D2? It is D1 minus standard deviation under root T. This is what you need for Black and Scholes model. And the most amazing part is, they will give you everything. See, they will give you everything over here. You only need to simply put the figures in the formula. That's simple. So you start now. Pay attention. See, the first thing is what we need for compute. See, this is the main formula. But first you need to compute D1 and D2, and then ND1 and ND2, which I've already given, and then you need to compile the whole formula in the main one. So what you'll do right now, first everybody over here, you need to compute D1 for me. Compute D1 right now. So I'll show you the figures also. So D1 is over here. Compute D1 and tell me what is the answer. D1. So D1 is equal to logarithm spot upon, what is the spot price? 80 upon exercise price 75. Next, plus how much is the RF? RF is 12. So 0.12 plus standard deviation how much? 0.40 square upon 2 into T is how much? 6 upon 12 into 6 upon 12 whole divided by how much? Standard deviation under root 6 upon 12. Anybody who has got the answer for D1? I want the answer for D1. I want the answer for D1. Okay. So for example, what is logarithm of 80 upon 70? What is 80 upon 75? This is 1.067. They have already given you what is the log for 1.06. It is 0.0646. So 0.0646 plus, solve the bracket please, solve the bracket. 0.40 into 0.40 divided by 2 plus 0.12. This is how much? 0.2 into 6 divided by 12. So 0.1. 0.1 whole divided by 6 divided by 12 under root into 0.40. This will come 0.4828. What is your final answer? What is your final? Everybody, final answer is how much? 0.0646 plus 0.1 divided by 0.4828. You will get something 0.3409. Are you getting this? Are you getting 0.3409? Everybody, 0.3409. Now pay attention. This is your D1. What is your D2? What is your D2? So D2 is D1 minus T. So 0.3409 minus 0.4828. That is the figure which is above only. Standard deviation in under root T. I think this answer is wrong. I think this. Just compute the figure for this. How much it is coming? How much it is coming? This figure. D1, the first one. It is 0.0646. This is right. 12 RF. 0.40 into 0.40 divided by 2 in plus 12 into 6 divided by 12. 0.646 divided by 0.4828. 0.40 into 0.40 into 0.40 divided by 2 plus 0.12 into 6 divided by 12. No, this is right only. 0.0646. 0.1646 divided by 4828. Is it 3409 everybody? 0.3409. 0.5820. Achare, so sorry. I took it here. No, this is right. 0.5820 is the right answer. 0.4828, 0.58 is the right answer. 0.5820. So 0.5820 minus standard deviation how much? 0.40. 6 divided by 12 into 0.40. Achha, this is wrong. This is wrong. 20. So what is the final answer? D2 is how much? How much is D2? 0.5820 minus 0.20. So this will be 0.382. 0.382. See, they have already given you the figure for this. They have already given you the figure 0.3820. And this is how much? Standard deviation 0.5820 minus 0.20. 0.382. Is your D2 coming 0.32828? Denominator is 0.2828. What? What are you telling? Oh, right. What am I doing? 6 divided by 12 under root into 0.40, 0.2828. No, one sec. We're getting something wrong over here. Into 0.40 is 0.2828, right? And this will also become 0.2828, and this will become 0.5820 minus 0.2828, 0.2992. Is this the answer you're getting? Yes, this answer, both the answers are matching. So 0.4820 is matching and 0.2992 is also matching. And they've already given the figures for what? D1 and D2. So what you'll do now? So now you've already got D1, you've already got D2. But in the formula, it is not D1, D2, it is ND1 and ND2. The normal distribution. So that is the figure here. So now do one thing, put the figures over there. Now. So what you will do? Go on to the main formula. So this is your main formula, spot. How much is your spot? Please tell me. How much is spot? Your spot is 80. Okay. Into ND1 is how much? How much is ND1? It is 0.7197. So what you will do? Into 0.7197. Next, minus your exercise. How much is your exercise price? 75. 75 into, how much is it? E raised to RFT. So E raised to RFT, how much is the risk free rate? It is 12 into 6 upon 12. This is 0.06. And last is what? ND2. How much is ND2? ND2 is how much? 0.6176. 0.6176. Now compute this and tell me the final answer. You have to compute this and give me the final answer. You have to compute this equation and give me the final answer. So 80 into 0.7197. 80 into 0.7197. 57.576 minus 75 into that we can do. So 75 into 0.6176, 46.32 into, this also into 1 upon E raised to. Now how much is the value for this? In the question not given or what? This is given 1.062. I hope that's the value for that now. Achha, we'll do one thing. We'll compute the value. Give me 2 minutes. I'll compute the value. I'll just check whether it is same or not. 2.7183. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 minus 1 into 0.06 plus 1 is equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Are they given the value? So this, the value matches, okay? So this value is there, or this value 1.062, that is the value for that E wala thing, okay? So this is the value for that. So basically into 1.0612. Your final answer is how much? 46.32 into 1.0612 and minus 57.576. Your final answer is 8.10. Has everybody got it? 8.10. Yes, Devesh, your answer is right, but they've already given the question. This 1.062 is what? That is nothing but that only. So your final answer is what? Your final answer is 8.1. That is the value of your call. Value of your call as per Black-Scholes. So remember one thing. Many students will leave out Black-Scholes. The only problem in Black-Scholes is what? The computation part. It's a big formula. So see, if you're writing this formula SND1 minus ERFT ND2, the only point you need to know what is D1 and what is D2, and they will give you every information. You only simply need to do what? Put in the formula. So do one thing, revise this. Okay. Now we'll do one thing. We'll start Forex. We'll start and we'll take a short break. What is the timing? It is 6:37. Okay. So we'll start at 7 p.m. Take a small break, everyone. Am I audible? Am I audible? Yes, I'm audible. We're starting at 7 p.m. only. I think I came very early. So I wanted to show you this also. So this was not decided, but I think I'll take your SCM section C marathon. And we are also preparing on section D marathon also, okay? Let everyone come in, then I'll give the announcement. Sparsh, arbitrage question they'll ask you, but the short ones, not the bigger ones. Shivendra Singh, how many subjects do I expertise? So SFM is there, law is there, IDT is there, this one is there, SCM that too. So tab tak clear my doubt. Arey Zabi, I'll clear your doubt. I have your phone number, so I'll clear it afterwards. That this no, you want the interest rate swap. Don't worry. I'll explain you after the marathon, and then only I'll go home. Okay? Don't worry about that. I'll explain and only I'll go home. So who is this? Niranjan. So expertise is FM. I have already lecture recorded. SCM is one. This is coming up. This is for your this exam. Section C, full everything. Your CPM PERD, your assignment, your transportation, your LPP, everything will be covered over there. We have one more faculty. His name is CMA Kapil Talreja. He's a gold medalist in his finals. So he's getting ready for your section B marathon also. Your marginal costing and standard costing. Okay. So the date is not yet confirmed, but it will happen before your exams only. Okay. But this is going to come soon. I think your SCM is on the 1st of July, if I'm not wrong. Your strategic cost management paper is on 1st of July. So what we'll do is your previous paper, by the time you come from your paper, we'll take that marathon. Okay. This SCM marathon. I'll announce the date afterwards. But do you need the marathon for section number C? First of all, tell me that. Do you need section C marathon, or everybody's done on section C? Is everybody done on section C? Yes, no? You are done. No, this guy is done. Yes. So I know full Forex would have problem in option hedging in Forex. Arey Sparsh, go do one thing. No, you can do one thing. Just go on YouTube. My video is already there on Forex. If possible, please provide early. This was not in the schedule. So what happened yesterday? What happened? There were a lot of people who were asking me for SCM marathon. That's why I did. First, the whole Forex video is there. You can just go there. I have explained everything in that. Marginal and standard costing. Yes, Kapil Talreja sir is there. He's a cost manager. He's a CMA himself. As I mentioned, he's a gold medalist in his finals. So he is in charge of the section B. So he's getting ready for it. So if it comes, I'll drop it immediately. Okay, I'll share it across also. By the way, the number which is there in the description, so you can just put it over there. We need SCM section C. That is there. That's what I'm doing. Okay. And also you had mentioned one more thing, law. So even that was all of a sudden. Yesterday only, I think yesterday a lot of people were there. I think even today a lot of people are there, but they have gone out for a break, I believe. We'll start sharp at 7. So I'll provide this also. We'll take Forex now. Forex will go around for an hour, and then I'll take few sums from mutual funds, and then we'll call it a day. Okay. And after that, if you need any FM, because see, today you have to finish up FM. Okay, and then you have to start studying for other subjects also. Can you please drop in your comments, please? I just want to see from which part of India you are. Can you please drop From which city are you from? Everybody who is watching right now. From which part of India you are watching? I mean, from where you are watching? From which city you are watching? I just want to. Zainab, today leasing is not possible. You know why? Because I have one more lecture scheduled at. It's actually at 8 p.m. So I need to wrap up before that. Are Niranjan, don't worry about section C. Section C, if you only watch my marathon, no, it is more than enough. Only marathon, don't do anything else. Just watch my marathon, that's it. You will not need anything else. Listen everyone, listen. Leasing, they are all big sums. Remember one thing, I need to solve. I don't have the habit of doing of putting up the answers and then just going on checking it. I don't like that. So for solving, I need a lot of time. So see, and leasing is simple, it's not that difficult. Acha, Uttar Pradesh, Bangalore, Nagpur, Hyderabad, Kerala, Karnataka, and other people, only these people are there or what? What about other people? What about other people? Nobody is there from Pune or what? Nobody is there from Pune. Chennai. What about others? There's so many people watching and now they're coming. It's 7 o'clock, that's why. It's 4 minutes to go fast. Manasi Bhide. Acha, now she's only one from Pune. Oh my god. Everybody else is from outside. One is from Jharkhand. What about others? Mansi, you're typing Pune 2 times a word. What about other people? So we have Nagpur, we have Bangalore, we have Chennai, we have Hyderabad. Let me go up. You have Pune. What about other people? There's so many people watching. You start sharp at 7. 3 minutes to go. Okay. Odisha. Acha, even we have got one more from Pune. Asha is from Bangalore. Asha, you first retracted your message. Again, you typed Bangalore. Okay. So the people who are joining in new. So I'm going to take this revision also. That is your SCM. And if you're done with your studies for SCM, that is completely fine. If you're having a dilemma over there, just watch this video which I'm going to put. It's not yet put. Okay. So I might take it online live also, like the way I'm taking it right now. Sir, एक लॉ का क्वेश्चन जो अलाइड लॉज पार्ट है उसमें से मोस्ट इंपॉर्टेंट चैप्टर्स कौन से हैं? दिस इज द मोस्ट कॉमन क्वेश्चन. स्पर्श, if you would have been yesterday in marathon, this was the same question which everybody was asking. This law wala question. So when I started talking about it, everyone said no, this is a corporate law, we are done. Only allied laws पूरा बैंड बचा पड़ा है. So see, I am focusing on allied laws only. Wait. IBC, your SEBI, SCRA, okay? We'll take it. और वो public likes मारो ना, likes कितना कम है वीडियो को. Put some likes for the video also. अरे गौरी, तू माहितीस मला, विषय नाही आहे. Likes ठोको जरा. Okay, I might take this SCM, this only, live only. You only need to watch this, that's it, done. Okay, should we start? It is 6:59. Chalo. I have one more lecture planned at 8. So I hope I finish this up before that. Oh, where's my charger? I just put it right now only. But good, yeah, you guys are showing response. That's a very good thing. How many of you did yoga yesterday? How many of you? Okay, it is 7 p.m. I think we'll start. Pay attention, please. Okay, cool. I want everybody to be very sharp. Okay, pay attention, everyone. Should we start? Yes, no? Okay, now please. योगा हमसे नहीं होगा. क्यों नहीं होगा रे भाई? Yoga is very important. How to revise law, that I'll tell in that video. This is FM video. Okay, so pay attention. So Forex, we're starting. Pay attention. That's very important. Four chapters are important. Your capital budgeting, your portfolio management, derivatives, and Forex. We're down with 3 chapters. We are focusing on Forex, and then I'll wrap up with your mutual funds. Okay, mutual funds also, please do not take it very lightly. Okay, there are a lot of questions which are very tricky in mutual funds. Okay, now talking about Forex, that is foreign exchange rates. Please pay attention. I've already got a video uploaded on my channel. If you just type there Forex Hgpa, you'll get the video. Okay, there is a detailed explanation of everything in that. In this, I'll explain everything. We're taking questions also, the MCQ types. So Forex, every student makes a mistake, and you know what is that? Ek to they will ratta everything. They will ask, this is there, this rate is taken. They will see the answer, choice answer also. But what, in my opinion, Forex is all about your basic understanding. Everybody pay attention, huh? Everybody pay attention. Now you might have done Forex from a lot of other faculties. See, every faculty has a very unique way of teaching Forex. Okay, so even I have a unique way of teaching Forex, and so if you get confused, so please don't mind. Okay, so whatever is there, answer will be same only, but the way of teaching will be very different. I will teach you in a very simple language. Okay, now what is the meaning of basic understanding? The basic understanding is of your quotes. What do you mean by quotes? Your direct quote and indirect quote, your base currency and incidental currency. If you are in a position to understand these things, Forex is simple. Trust me on this. But if you are not understanding these concepts, it is going to be difficult. Okay, so there are 4 concepts which you put in your mind. 1, what is the meaning of direct quote? What is the meaning of direct quote? What is the meaning of indirect quote? What is the meaning of base currency? And what is the meaning of incidental currency? What is the meaning of incidental currency? Everybody pay attention. I want everybody. Okay, we'll start off with direct quote. Okay, now pay attention. To start with direct quote, I'll give a very simple example. Okay, so we all stay in India. For us, $1 is equal to, let us say, example, it is 77 rupees. What is this? Now, this is a direct quote if we are staying in India. How, sir? So, in what is the rule of direct quote? The foreign currency is constant. What is the foreign currency for us? It is a dollar. It is always constant. $1 is so much. $1 is so much. Okay. Recently, the markets went down. The rupee went crashing down more heavily. Okay, so this is a direct quote example. Okay, whenever you guys are in a confusion, when you guys are in a dilemma, कि baba how to understand direct quote, indirect quote, ekdam easy. Just this example put in front of you. $1 is so much rupees. What is this? Is very common. So every Indian, they always compare with dollars only. So in a direct quote, the foreign currency is what? It is constant, and the domestic currency is varied. What is the meaning of varied? It keeps changing. So rupee might be 77 today, it might be 80 tomorrow, it might be 60 also. So the domestic currency is changing. Now this is the meaning of direct quote. Okay. Now, obviously, what is indirect quote? What is the meaning of indirect quote? Please tell me. So, if I tell you like this, if you are in India, I'll tell you this: 1 rupee is so much dollar. Okay. Example. What is this? This is an indirect quote. Why? Because you are staying in India. What is your home currency? Your home currency is rupees, and the home currency is constant over here. So that is the indirect quote. Are you getting this thing? So what is the meaning of direct and indirect quote? Direct quote का मतलब क्या होता है कि boss, there is the foreign currency is constant and the domestic currency is varied. Okay, simple. Now pay attention. One more thing. The most important part. If $1 is equal to rupees 70 and rupees 72, what is the meaning of the same? The main point in Forex is identifying the quote, identifying the currency. So, dollar is said to be base currency. Anytime when you see a quote, the symbol, the currency which is at the left hand side, matlab the first one, that is the base currency. And please pay attention, this currency is only being bought or sold. Whenever you are thinking, always think from which angle? From the base currency angle. I'll tell you within 2 minutes, okay? We also going to take cross rates also. That time you'll understand what exactly is this meaning. First we'll take a warm up. First I'll understand whether you are understanding or not, and then what we'll do, then we'll go on to the sums. Okay. I also tell you what is interest rate parity, what is inflation rate parity. Okay. Afterwards, money market hedge and all that. Okay. Money market hedge is very important, by the way. So that is the base currency. There's one more concept known as what? Cross rate. Cross rate. What is the meaning of cross rate? See, in the whole world, there is no specific standard that this currency will be quoted against the other currency. Not possible. So you need to compute cross rate. I have taken those questions also. Okay. So we'll do one thing. We'll take one simple question over here. I want everybody to solve, and let me see whether you are understanding or not, and then we'll go forward. Okay. So take a question down for cross rate. Take a question down for cross rate. One second, I'll give you a question. I'll give you a simpler question, not the difficult one. Okay, cool. This looks decent. $1 is equal to rupees. That's the 41.2. It's a very old sum. 550 and 41.2650. We have also $1 is equal to French franc, FRF, 6.0500 and 6.0550. Give me the quote rupees. So write the question only. At what rate one can buy FRF against rupees? At what rate one can buy FRF against rupees? This is the question of cross rate. Understand the meaning of cross rate first. See, listen. So you have rupees in your pocket. Everybody pay attention, okay? You have rupees in your pocket and you want what? You want FRF, French franc. You want French franc. So when you go in the market, you are not able to see a quote where it is given rupees and FRF. There is nowhere. See, first they are quoted against dollar and rupees, and then it is dollar and FRF. You have to bring FRF and rupees together. How? That is cross rate. Okay. So simple. What is the steps for this solution? What is step number one? Step number one is currency in hand. Currency in hand. So what is the currency which you have in your hand? And that is rupees. What currency you have in your pockets? You have rupees. Okay. You want what? FRF. So write down. Currency required. Currency required. This is what FRF. You have rupees, you want FRF. How will you go there? How will you go till FRF? So make a chain, make a chain. So what you will do? First, you will convert rupees into dollar because you have pocket, you have rupees in your pocket. So first rupees into dollar, then you will convert dollars into FRF. This is the chain which you should follow for this sum. First convert rupees into dollar and then into FRF. Then you will get the rupees and FRF quote. So what is your first step? Your first step is for converting rupees into dollar. I want everybody to solve the question. Everybody to solve the question. I want the answer, okay? But this is the basic. Understand the basics first, okay? Rupees into dollar. So this is the rate. Now I'm asking everyone. Please tell me which rate should I select? Which rate should I select? Which rate should I select? Aditya Agarwal, what you are telling? This is the final answer. It's a very simple question. My question is, if I want to convert my rupees into dollars, which rate should I go for? This or this? I want the answers in the comment box immediately. Fast. I'll wait. Anyone? Which rate you will select? 41.2550 or 41.2650? I know. 41.2650. Okay, very good. Okay, fine. See, listen. So, Baba, for the ones who do not know this, what is going to happen? I go to the bank. What is the base currency? It is dollar. Forget the rupees. What is the market buying and selling? It is dollar. Okay. Remember one thing. We have rupees in your pocket. You go there at the bank. And Baba, what is the quote? What is the base currency? They tell dollars. So remember one thing. Do you have dollars in your pocket? No, boss, you don't have. You have to buy dollars. So when you buy dollar, at what rate the market will give you? At the most expensive rate. What is the thumb rule in the Forex? The market will always give you less. But it will take more from you. So your first rate is $1 is equal to rupees, the expensive dollar rate, which is this 41.2650. 41.2650. Prepare this, rupees upon dollar. Okay, this is your first step. So this first chain is over, good to go. Now dollar into FRF, that's the second thing. So second point, convert dollar into FRF. Okay, now go on to the quote. Now this is the quote in front of you. Now please tell me what rate you will use. Anyone? Which rate you will use? 6.0500 or 6.0550? Tell me one thing. What is there in your pocket right now? Obviously dollar. That's what it did. Now what is the base currency? Again it is dollar only. So the market is buying and selling dollar again. So now you have dollars in your pocket now. So you will again buy dollars or what? No, Baba. You will sell dollar. So when you will sell dollar, which rate will apply? Market will give you very less, boss. They will not give you more. So this rate will apply 6.0500. 6.0500. So $1 is equal to FRF 6.0500 FRF upon dollar. Now what is the C? What is C? Tell me what is C? That is elimination of cross common currency. Elimination of what? Common currency. What is the common currency, boys and girls? What is the common currency? It is dollar. So what I'll do is rupees upon dollar into, can I write FRF upon dollar? Can I write the same code down? So boss, how will you cut it? You cannot cut it, no. So you will write it ulta. You will write it FRF upon dollar. Dollar upon FRF you will write, and that's how this will go. Dollar and dollar will go. So tell me what is the final answer. So what is rupees upon dollar? This is over here 41.2650. So I'll write here 41.2650 into dollar upon FRF. This is ulta. So what I'll write? 1 divided by 6.0500. How much is this? Into 0.1652 something 89. Okay, so into 41.2650. Answer is what? The answer is 6.8206. This is the answer. So what is the final answer? 1 FRF is equal to rupees 6.8206. Has everybody got this answer? Yes, no? Niranjan, that's the right answer. Okay. So remember one thing, you might know this concept. So that's what I'm telling you. Whenever you are learning any chapter, first do the basics right. If you do the basics right, everything is going to become rock solid. Okay. So this is the answer. So this is the meaning of cross rate. The meaning of cross rate. Okay. Next. Now, there are some factors. I'm taking question in a minute. Okay. Please pay attention. Factors affecting forward rates of exchange. Forward rates of exchange. And also one more thing, everybody, the classes which you all are taking from me, okay, these are all exclusively for CMA final. We do not combine any other thing. So for example, the same syllabus is there for CA final also, okay, even for CS professional, but we do not do that. You know why? Because see, chapters might be same, but the pattern, the questions come in the exam are very different for whom your CMA final. So these classes are exclusively for CMA finals. Okay, now please take a note for that. Why am I telling you? If any other children is there over here, if any other kid is there of CMA final, so I'm telling, so you can just understand the concept. But remember one thing, you need to solve it by your pattern. Okay, not by CMF. This is CMF final exclusively. Okay, which are the factors affecting the forward rates of exchange? So first factor is interest rate parity. Interest rate, there are a lot of questions on this, interest rate parity, please pay attention. Second, inflation rate parity. Inflation rate parity. Third, expectation parity. Expectation parity. And last is international Fisher's effect. International Fisher's effect. Okay, one more thing. This inflation rate parity is also called as PPP, that is purchasing power parity. I'm repeating myself again. Inflation rate parity is also called as purchasing power parity. Okay, so please take a note of this thing. And the formula is very simple. Okay, what is the formula? Okay, pay attention. 1 plus ID upon 1 plus IF upon F upon S. What does I stand for? Interest. If they are giving you, if they are giving you inflation, then that is it. So basically this I is the rate of interest. If they are giving inflation, then put that over there. But this formula is not going to change at all. This is the formula. D stands for domestic, F stands for foreign. This F stands for what? Future forward, and this S stands for spot. Now everybody pay attention. There is one twist over here. I don't know how many of you know this. This formula is only applicable if it is a direct quote. This formula is only applicable if it's a direct quote. If it is an indirect quote given in the question, then the formula becomes 1 plus ID upon 1 plus IF is equal to S upon F. This changes. Spot upon forward. This is for whom? This is for indirect quote. This is for indirect quote. I'm repeating myself again. Remember, whenever they're asking about parity relationship, interest rate parity, inflation rate parity, the formula is same. 1 plus RD or 1 plus ID upon 1 plus IF or 1 plus RF upon F upon S for direct quote. 99.99% will give you direct quote only. But if the institute wants to confuse you, if they want to put a bomb in your question, they will give indirect quote and then they'll tell you to solve this. So please, in that thing, this is the formula. S upon F it is. Getting it simple? Now, please pay. Somebody asked me about money market hedge, okay? Please pay attention, I'm explaining, then I'm going on to the questions, okay? What are the options for hedging? First of all, understand the meaning of hedging. What is hedging? Hedging means to reduce your risk by some other alternatives. What is hedging? reducing your risk by other alternatives. If you as a finance manager are working somewhere and if your company is dealing in forex transactions, so the board of directors obviously will want to protect themselves from what? From the fluctuations in the forex market. For that, hedging is going to come into picture. By how many ways you can hedge? The most simple is what? The most simple is what? The most easiest. The most easiest. Enter into forward market. Enter into forward market. This is the most easiest. Next, one of my most favorite, and that is money market hedge. Money market hedge. Next, currency options. And next, currency futures. I'm repeating myself again. Forward market, money market hedge, currency options and currency futures. Okay. Now, I'll explain this. I'm repeating myself again. There's already a Forex video uploaded. In that I've taken big sums. So you can go there and watch that video. Okay. In that there's full explanation. But right now I will tell you what is the meaning of money market hedge. Please pay attention. Money market hedge. Money market hedge. Okay. Understand the concept. Don't solve also. Understand the concept first. Okay. Let us say now you are in India. You are in India, and there's a question which they are asking that you need to pay someone. Understand. You let us say you have imported something from UK and you need to pay that fellow over there in UK. Let us say 3 months time. You need to pay someone in UK after 3 months. So what will you do? Please tell me. You need to pay, that is confirmed. So today you will go and deposit some amount over there. Where? In UK today. For how many months? For 3 months. So after 3 months you will get interest on that. So this amount should be equal, the amount which will come over there, which has to be equal to the amount which you need to pay to that fellow. So whenever 3 months matures, your deposit will mature. The deposit plus interest amount should be perfectly matched with what? The amount which you need to pay to that fellow. That means this reverse calculation over here. Okay. So this amount which you will deposit, from where it will come? From upper? No, Baba. You will need to take a loan. No. So you need to take loan in India for 3 months. And plus interest you need to pay, and this is your cost of your strategy. This is cost of strategy. As simple as this. If you have understood this, money market hedge is over. I'm repeating myself again. If you need to pay to someone outside, do one thing. Go in that country, deposit plus interest. That should be the exact amount which you need to pay to that fellow. Okay, and the deposit amount you should take loan in your home country. Plus interest, that will lead to what? The cost of your strategy. Okay, as simple as that. Now please pay attention. We'll take up a few questions and then we will end. Question number 33 on your screen. I want everybody to be very active. I want everybody. Solve it with me only. Solve it with me only. Do not say we'll solve it after and so on. Solve it with me only. In July, the 1 year interest rate is 4% on Swiss franc and 13% on US dollar. Okay. If the current exchange rate is Swiss franc is this much, what is the expected future exchange rate in 1 year? Now, you know what is the funny thing in this? The funny thing in this is, sir, what is the domestic? Obviously, what is this? Please tell me. This is your interest rate parity question. Interest rate parity. Right? What is the formula? 1 plus RD upon 1 plus RF is equal to F upon S. So, how did you understand it's a direct quote? From where? Did you assume it? Now remember one thing, see this is your MTB question, so they are not given anything. So how will you come to a conclusion? So please pay attention. What is given over there? 1 Swiss franc is so much dollar. If I am staying in the United States of America, for me, what is the foreign currency? It is the Swiss franc. So that is what I've assumed over here, that. We are staying in US, and for us, because this is a direct quote from whom? This is a direct quote for the people staying in the US, because Swiss franc is a foreign currency. So I'm writing over here, the domestic currency, domestic country is US, and the foreign country is France, Swiss. Now please solve this and give it to me. Please solve this and give it to me. Exactly, yes. First I'm taking that thing only. Right. So what is the answer? What is the domestic? Domestic is US. The one interest is from Swiss, and 13 is US dollar. So what I'll do? 1 plus 0.13. Okay. 1 plus 0.04 is equal to F. We do not know. That's what we need to find out. And how much is spot? 0.63. Please tell me what is the answer for this thing. It is $0.6845. This is the answer. Is everybody getting? Is everybody getting the answer? I want everybody to be active. Okay. 0.06845 is the answer. Simple. Next question. Next question. The 90-day interest rate is 1.85. Remember, they are very tricky questions. 90-day interest rate is 1.85% in US and 1.35% in the UK. And the current spot exchange rate is 1.6 pound. The 90-day forward rate is same question, same interest rate. Solve it and give me the answer. Please solve and give the answer fast. Everybody. Now please tell me one thing. What you will assume over? See, 1 pound is $1.6. So again I can assume one thing. It's a direct quote for the people staying in the US, because pound is the foreign currency. So domestic is what? US, and your foreign is what? Pound. Pay attention. I want the answer fast. So 1 plus, how much is it? US is 1.85. 0.0185 upon 1 plus, how much is it? 0.0135. F upon spot is how much? 1.6. $1.35 plus 1. I think it's for 90 days, no? 0.0185 plus 1 into 1.6 divided by 1.6 into 0.185 plus 1 into 1.6 divided by 1. What is happening in my calculator? Have you got the answer? This is your answer. 1.60. Very good. That is the answer. Next question. The current spot rate for the US dollar is 66. The expected inflation rate, don't get confused, the formula is same only, is 6.5 and 3%. The expected rate of dollar in a year is, so what is the formula? 1 plus ID upon 1 plus IF is equal to F upon S. I've just substituted R by I. Okay, simple. That's inflation. Okay, so can you please tell me what is the answer? So it is very simple. 1 plus domestic is how much? 6.5. So 0.065 it is. 1 plus 0.03 is equal to F upon spot is how much? 66. Please tell me what is the answer. Divide by 68.24. Is everybody getting 68.24? Absolutely right. Acha, now this is like cross rates. Okay. Now tell me what is the answer for the next question. The rates available in the Kolkata market are this. $1 is so much. and $1 is so much pound. If an Indian importer requires pounds, calculate the rate quoted to him. Now this is a cross rate currency question, which I solved it like when I started with Forex. Okay, now pay attention. First write down everything. What is the spot first? What is the spot rate? It is $1 is how much? Rupees 46.75 and 46.78. That is the forward differentials. Next quote is $1 is equal to pound 0.5285 and 0.5286. You know what is this called, right? This is called as the bid. One sec, I'll tell you. So where's my hand? This is called as the bid, okay, and this is called as the ask rate, and the difference between the two is called as spread. Okay, now tell me one thing, what is the chain what you will follow? So rupees converted into dollar and that converted into pound. This is the chain you should follow. First convert rupees into dollar. So tell me one thing, you have rupees in your pocket. What is the base currency? It is dollar. So what is the market buying and selling? It is a dollar. So the market will sell you at a low price or a high price? Obviously high price. See, so the answer is what? $1 is equal to, first is what? 46.78. This is your first rate. Rupees upon dollar. Okay, next, second chain, dollar into pound. Again the base currency is dollar only. You have dollar in the pocket now. So what you will do? You will sell dollar for how much? For less, because market will always take less and it will give less, it will take more from you. $1 is how much? 0.5285. I hope you guys got the answer. Now tell me what is the final answer? Rupees upon dollar into dollar upon pound. This will go. So 46.78 into what? 1 divided by 0.5285. 1.8921 into 46.78. Your answer is 88.51. Is it there? Yes, it is bang on target. A option is the answer. A option is the answer. As everyone got it. Very good, very good. Keep solving. See, even if you know these answers, please solve. It will boost your confidence, okay, for the examination. 88.51 is the answer. 88.51. Okay, next question in front of your screen. BLC Limited, a valued customer. Oh, this is such a beautiful question. Everybody, I want everybody to be very attentive, okay? It is a very, very good question. A valued customer engaged in import business is in need to remit 1 million euro to a European exporter. The spot rate is given to you and that of the US euro also given to you. What rate will a banker quote to BLC Limited if the bank's margin is 0.50%? It's a question of cross currency only. It's a question of cross currency, but it is very, very tricky. So what you will do, please tell me. First of all, please write the codes down. So one is what? $1. $1 is equal to how much rupees? 65.47 and 65.57. This is one code. Second code is what? 1 euro is equal to how much? Dollar. 0.8053 and 0.8057. These are the codes against every currency. Now what do you want? So you want rupees and euro together. So you are in India only right now. So what is your chain? Please tell me your chain. So your chain is going to be like this. First convert rupees into dollar and that convert dollars into what? Euro. Okay. How will you do it? Now first rate is dollar and rupees. So you go to the bank, the base currency is dollar, that is being bought and sold. So the first currency will be what? It is 65.57. That is the most highest thing. So first is what? I'll write it here. $1 is equal to rupees 65.57. That is the currency you write there. Rupees upon dollar. Next is what? What is the next code? You have dollars in your pocket right now. But what is the base currency? The base currency is euro. So do you have euro in your pocket? No, you want euro. So you will purchase euro at what price? At highest price. So 1 euro is equal to what? Dollar 0.8057. What is it? dollar upon euro. Now please eliminate the common currency. How will you do it? Rupees upon dollar into dollar upon euro. You don't need to do anything, huh? Don't do upon and all. It is very straightforward. This gets cancelled. So what is the answer? Simply multiply both this 65.57 into 0.8057. Answer is 52.82. Now you will see one thing, sir. This answer is not here only. So you need to add 0.50 to it. And then you will get 53.3 something. So your answer will be what? Which is the closest one? 53. One second. Rounding of difference it is. 65.57 into 0.8057 plus 0.5%. 53.09 is the dot answer. Dot. Not even 1 year and there. Has everybody got it? Mayuri, your answer is right, but you are not adding 0.50. See, what is the bank telling? Bank computed everything for you. You got the answer also. How much did you get? So if you just multiply 65.57 into 0.8057, you will get how much? 65.57 into 0.8057, you will get 52.82. This is not your final answer because the bank is telling we want a margin of 0.50. So add back. So add 0.50% to it. You will get 53.09. That is the exact answer. Is everybody getting 53.09? This is your answer. I hope everybody is getting. Okay, this is one more question. A very simple question, but they might ask you. You have to compute the percentage spread. Can anybody do it for me? You have to compute the percentage spread. Anyone? Percentage spread. Anyone? What is the meaning of spread? Difference between bid and ask. Is the euro to US rate indirect quote? What are you asking? Now, I don't know how. Actually, Niranjan, I have no idea how are you solving, but this is the way which I solve. I take the base currency as the point for deciding what is the currency to be bought or sold. Okay. What's the meaning of spread? Difference between bid and ask. Okay. So pay attention. So calculate the percentage spread on the euro and pound rate. Very simple it is actually. See, euro and pound is where euro pound it is here. So what is the difference between 1.6543 minus 1.6557? It is 0.0014, but you will not get any option over there. They are asking you what is the percentage spread. So divide by 1.6543 into 100. You will get how much? 0.085. 0.085. Is everybody getting the answer? Yes, very good, very good. So what is the answer? 1.6543 minus 1.6557 divided by 1.6543 because they are asking percentage, that is the base. Okay. Acha. Question number 39. Niranjan, solve this. Now this is a cross-state this question. The following codes are available from the State Bank of India. They have given you lots of codes. There are loads of codes now. Now see, the first one. 1 pound is how much rupees? 81.31 and 81.33. This is the first code. The second code. $1 is equal to pound. How much? 0.6491 and 0.6498. First write down the codes. There is one more they are giving you. 1 Japanese yen, that is Japanese yen. Okay, dollar is how much? 0.01098 and 0.01102. Now tell me one thing. What is that they want? They want Japanese yen and rupees against each other. They want Japanese yen and rupees against each other. Now, first of all, please tell me, how will you proceed? First, you will proceed rupees into pound. Please underline this question, it's very important. You can just divide this question before going to examination. Next, pound into dollar. and dollar into yen. This is the chain which you will use for rupees into pound, pound into dollar, and dollar into Japanese yen. Everybody needs to pin this answer. I want all the answers right, okay? Fast. Now, please tell me for the first one, when you're converting this leg, the first leg, that rupees into pound, what you will do? For rupees into pound, the first one, you are an Indian citizen, you go there. What is the base currency? You see, the base currency is pound. Pound is being bought or sold. So you will buy pound for how much? Obviously, buy it for how much? 81.33. Market is going to take more from you. So the first for the first quote is 1 pound is rupees 81.33. So please write this rupees upon pound. This helps you in eliminating common currency afterwards. Second, what is the second leg? The second leg is this pound and dollar. So tell me one thing, what is the base currency? The base currency is dollar. So dollar is being bought or sold. And what do you have in your pocket here? You have pound and the base currency is dollar. So what you will do? You again buy dollar. So again high currency rate. $1 will be how much? Pound 0.6498. So pound upon dollar. Last page is what? Dollar and yen. So the base currency is yen. Do you have yen? No, you don't have. So you will again buy it. For how much? More currency. 0.01102. And this is what? Dollar, Japanese yen. Now eliminate. Now eliminate. It's a very good question. Pound. Next you have pound and dollar. Next you have dollar and Japanese yen. There are two common currencies, pound and dollar. So please see, this and this, very big this is. See, this and this goes, this and this goes, last is of this. So please write down, what was rupees upon this? It was 80, 81, why green is coming? 81.33 into 0.6498 into 0.01102. See what is the answer? Anybody got the answer? 81.33 into 0.6498 into 0.01102. Your answer is dot 0.5824, and which is which option? Option number C. Option number C. Has everybody got it? I think yes. Asha, you have got it. Sparsh. Actually, the whole world has got it. Mayuri, Dipti, Hemang, very good, very good, very good. बहुत भारी. Very good, very good, very good. We'll solve one question. Please pay attention, everybody. Please pay attention, everybody. This question, please give me an answer. Bang, fast. Remember one thing, for money market hedge question, for your currency future, currency options, please go and watch my Forex video. I have taken everything. It is hardly some hours, okay? So even if you just end it after this, you will be able to just go watch it there and then finish up Forex today only, okay? So I'm not taking those big questions which I've already covered in that video already, okay? The question which I have not covered over there, because these questions are not covered in that video. So I'm covering this. For all the rest questions, just go and watch it over there. It will be a short full revision for you, okay? Last question. So Indian companies planning to invest in the US, the annual rates of inflation 8% in India. And please don't go away. Mutual funds, I'll take it, revise it with me only. There are some important questions which I want to tell you, like the Hgpa model, the Morningstar model, okay? So do mutual funds with me and then take off, okay? Indian companies planning to invest in the US, the annual rates of inflation 8% and 3%. Spot rate is this. What spot rate can you expect after 5 years? Arey, what a beautiful question. You might think this is very simple. Please answer. What is the answer for this? A 76.6 is already done. Arey, what, you know the answers from first? Okay, what? Sorry. So how do you do it? Simple. 1 plus ID, 1 plus IF, F upon S. Now, domestic is what? It's India. So inflation rate is how much? 1 plus 0.08 upon 1 plus 0.03 into F. Now remember, this is for 5 years. This is for 5 years, okay? And then it is F upon S. What is S? 60.5. You need to do 5, okay? So 3, 4, 5. This is 1.46932, 0.03 plus 1, 345, 1.15927 f upon 60.50. Just see what is the answer, please. 1.46692 into 60.50 divided by 1.15927, and your answer is matching at 76.68. 76.60, that's your final answer. Are you getting this thing? Okay, everybody getting yes, no? Why do people call? They know I'm taking a marathon, still all the students will call me. I have no idea about that shit. 4 people are calling. They know I'm in a marathon. Okay, now this is enough for Forex. For more questions, you can go to my Forex video. Just type on YouTube, you'll get all the big questions over there. Okay, now last but not the least, the most easiest chapter, which everybody thinks it's easy, but there are few tricky in that. Okay, and that is mutual funds. But before I start mutual funds, no, I'm not giving you a break. I'm telling you that I want you to write down some formulas which I've already prepared for you. So can I do one thing? Please write down these formulas so that the life will be very easy for you. Okay. Now, first thing, this is the first one. See, this. How much should the mutual fund earn? So remember one thing. There's one thing. There's a formula for that. Desired return. Everybody just pin it down to one page only. Okay. Desired return divided by 1 minus initial expenditure, initial expenses, plus annual recurring expenditure. Everybody needs to write down the formulas in one page. Annual recurring expenses. Okay, this is one formula. Second, Hgpa formula. Hgpa, write down please. RP minus RF upon standard deviation of portfolio. This will be very easy for you to just get it in one page only. Okay, Hgpa. Next, trainer. TREYNOR, trainer. That is RP minus RF upon beta of portfolio. Beta of portfolio. Next, you have Jensen's alpha. Jensen's alpha. Write on one page only, so that whenever you take mutual fund for revision, just do these formulas. That is more than enough. Okay. Jensen's alpha is RP minus RF minus beta RM minus RF. Okay. So these are some important formulas for your mutual fund. See, for mutual fund, there is typical set of questions. Typical. They'll ask you how much return it is. They'll ask you what is Hgpa. Hgpa is asked a lot of times. Okay. So write this in your book somewhere. Write this in your book somewhere. Okay. There's also one more thing, that is the Morningstar model. Okay. That also I'll give you. I've taken a question also for Morningstar model. Okay. Chalo. Now I want everybody to do this very fast. Okay. Chalo. Now, very simple. Finish it with me only. Okay. First, Mr. X earns 12% by investing his equity shares on his own. Now he's considering recently announced equity-based mutual fund scheme in which the initial expenses are 5% and the annual recurring expenses are 1.5%. How much should the mutual funds earn to provide him a return of 10%? Now, by the way, sorry, everybody knows now what is the meaning of mutual fund. Mutual fund सही है, वही यही है, ठीक है? तो it is nothing but they pool every investment together and they put it in the stock market. Okay, there are a lot of investments over there. So that what happens, mutual funds are run by all the intellectual people, so that you don't have to devote time. So they devote time for you and they charge commission for it. Okay, so the questions asked in your examinations are very typical. The first one is this. I've just written a formula for that. So this is this formula. How much your desired return? How much you want? You want 10. 1 minus how much is your initial expenditure? That is 5. That is 5%. Plus how much is your recurring? 1.5. How much is the answer for the first? Anybody? 12.02. 12.02%. 12.02. Very simple. Okay. Next. Remember one thing. If you were there in my yesterday's marathon, when I was explaining you portfolio management, I had given you one formula, return of single security. What was it? D1 plus P1 minus P0 divided by P0. Remember one thing. In mutual fund, there is something called as NAV, NAV. That is your net asset value. Total assets minus total liabilities divided by total number of units. We don't call it shares, because when mutual fund issues something, they don't issue shares, they issue units of mutual fund. So if you want to compute the NAV of a mutual fund, total assets minus total liabilities divided by total number of units. Very simple. Okay. Now, what is the C? Mutual fund has a net asset value of 10 at the beginning of a month. This means what? This means what? At the beginning of a month, matlab what? This is your NAV 0. See, P1, P0. What is P1, P0? Expected market price, current market price. What is NAV at the beginning? NAV 0. Okay. Made income, capital and distribution of 0.05 and 0.02 per unit during the month. The fund ended the month with a net asset value of 10 points. What is this? This is NAV 1. And what is the monthly rate of return? Very simple. Add everything. Add everything what you see. See, for example, so 10.08 minus 10. This is what? Opening, closing. Okay. Plus, what are they distributing? 0.05 plus 0.02 divided by opening. What is opening? 10. What is the answer? Answer is 1.5. Very good, very good. Ravi, what do you want me to explain? Please explain, but what I should explain? Has everyone got this? Very simple, very simple. Oh, this is a very good sum, very good sum, very good sum. Acha, chalo. Can anybody solve this question 3 in front of you? Question 3, I want everybody to solve this question. Question number 3, right now. Everybody. I want to see who gets this answer right. I want to see who gets this answer right. Chalo, everyone. Fast. Okay. No one has got the answer right. It is very simple actually, but there is one trick in that. See, so they have given you the annualized return already. They have given you that. So this is already given. So you need to compute that. What you need to compute is the NAV 0. So what you will do is 12, then x minus 60 plus 0.40 plus 0.30 divided by 60. Okay, what is the answer? Now remember one thing, this is the annualized return. They don't want annualized, they want monthly. So this is nothing but what? This is 1%. That means what? 0.1. See what is the answer? 60 plus 6 minus 0.7. No. Is anybody getting the answer? 66.5. I'm sorry, there is no option there. There is no option. Everybody is getting the same answer. 66.5. How? NAV. What is the answer? 65.3. That's what even I've got. Shambhi, I've got 65.3 only. But the point is there is no option in this. Because see, this is annualized return. No, this is annualized return. Annualized is what? That is 12 years. So what is 1? That is obviously 1%. That's what we did, but we are not getting the answer. Anybody got the answer? 65.3. Yes, I've got 65.3 only. This is the answer actually. 65.3. Akash, yes. This is the answer. This is not there. So this might be wrong, but the answer is 65.3. 65.3 is the answer. Next. Question 4, everybody. Question number 4. Question number 4, you can do it on a calculator also, okay? You can do it on your calculator also. You do it, don't take 12 because that is 12 annualized. That is the trick over there. They are asking monthly. You need to put 12 divided by 12, okay? Now, what is this question number 4? They want NAV of the scheme. What is NAV of the scheme? Very simple. Assets minus liability divided by total number of units. How will you do it? So remember one thing. What you'll add? You'll add this. You'll add this. You'll subtract this. So 220 plus 1 minus 0.5 divided by 1.5. The answer is 147 dot. What I did? 220 plus 1 minus 0.5 whole divided by 1.5. You will get 147. You will get 147. You get 147. Somebody has got the answer right. Mayuri has got the answer right, I believe. 59.9. How she got the answer right? Look, her answer is matching with the options also. No, that 147 is okay. No, there's one girl over there who's got the answer right. 59.9. Oh. 1 sec. 0.6. .6 160 exactly. Very bad. Sorry. The answer is right. The answer is not this. The answer is Shamvi. Pay attention. You and me, we both did the same mistake only. So the Mayuri has done it right. Very good. Are this is 1%. This is 1%. No, we all did 60 into 0.1. So 60 into it is 1%. 60 into 1% it is. So this is 0.6. This is 0.6. And then this comes plus 0.40 plus 0.30. So what is the answer? This will be 59.9. Mayuri, very good. No, the answer is right. 50. Everybody, Shambi, did you get 58.9? Yes, good. I got it. So we did 0.1. We did not do it percent. Yes. 59.9 is the answer. Yes. Good. This is 147. This is very simple. Very good. This is very simple. I think now I do it very fast. 72. Do it on the calculators only. The next question. 72 minus 60 plus 2 plus 6 divided by 60. How much is the answer? 33.33. Oh my gosh. Question number 6 in your screen. Yes, Mauri, thank you so much. We are thanking you. You should not thank us. Acha, Sharpe ratio, everybody. That is why I gave you in the starting. Sharpe ratio. What was Sharpe ratio, please? It was RP minus RF upon standard deviation. Barabar. What is RP? 13 minus RF. What is RF? 10. What is standard deviation? 15. What is the answer? Minus 10 divided by 15. Answer is 0.20. Everybody getting 0.20. I have given you Sharpe ratios, okay, at the start only. I have given you ratios at the start. Everybody pay attention. Very good. Question number 8, everybody. Question number 8. That is not an optional. This is not the section A wala question. This is the down wala question, which will come for many marks. Now you might feel, sir, both same. No, it's not same. It's different. It's an MTB question. Okay. So they are asking you to compute the monthly return. Monthly. How will you do it? Pay attention. First, compute the normal return. What is the normal return? So what is the NAV at the end? So it is 14.25 minus 14.5 plus 0.60 plus 0.40 divided by 14.5 into 100. So it is 5.17. Is everybody getting 5.17? Is everybody getting 5.17? Who's this Bharadwaj Kashyap CMA final? Please provide. Yes. The Bharadwaj is there right now. What? The 5. Is this your final answer? No, Baba. This is not a final answer. You see, this is 90 days. See, remember one thing. 5.17 is your return. But remember one thing. What is your annualized return? So, 5.17 into 365. See, 5.17 into 365 divided by 90. So you will get how much into 365 divided by 90? This is your annualized return, 20.96%. But they are asking you what? Monthly return divided by 12. So answer is 1.74. This is your answer. Is everybody getting? No. Dipti, the answer is wrong. See, 5.17 you got. That is right. But understand the question. They are asking you what is monthly return. So what you will do? This 5.17 you got, then compute the annualized return. If 5.17 is for 90 days, how much for 365? So what I did, this is your annualized return, 20.96, and then compute monthly return divided by 12, and then you will get 1.74%. That's very good. Hemang is right. Very good. Hemang is right. Very good. Did everybody got? Yes, very good. Mayuri, you got the answer right. Very good. I think people are living out for what? So we can do the like 5.17 divided by 90 into 30. What is the answer you're getting in 5.17? What divided by 90 into what? 30. 1.7. Yes. They're getting the answer, no? Cool. Okay, now pay attention please. I'll solve the last question. Please pay attention. The last question is about Morningstar model. The last question is about Morningstar. It's a lengthy wala question. Pay attention. Last question is this. What is the meaning of Morningstar here? Morningstar always compares with risk free. So I didn't get how 5.17. Niranjan, pay attention. Okay, I'm explaining the sum again. See, Niranjan, tell me one thing. You didn't get 5.17 only, or what? See, Niranjan. See, 14.25 NAV at the end minus 14.50 plus 0.60 plus 0.40 divided by 14.50. If you solve this, you will get 5.17. Please do it. Did you get 5.17, Niranjan? The marathon is waiting for you. Niranjan, India wants to know whether you have got the answer or not. I think he's still solving. It's a simple calculation. Fast. Just put yes over there if you have got it. Everybody's watching. Achha, good, got it. Gone. Okay, chalo. So Morningstar model, pay attention please. You have three funds. Last sum, pay attention. Last sum. Fund A, Fund B and market portfolio. Always compare with the risk-free rate. How to do it? Please do it right now with me only. Okay. So first, one sec. So first we'll do it for Fund A. Everybody should solve this. Okay. Everybody should solve this. First do it for Fund A. So Fund A. So Fund A, you need to do two things. One is your return and the other is your risk of loss. Risk of loss. Okay. So remember one thing. How much is your return? 3, 1.75 minus 1, 3.5, 1.5 and 0. Always compare it with your risk free. Now what is the problem over here? The risk free is 6% for what? Are Baba, 6 months. But remember, this is monthly. This is monthly. What is per month? So per month will be what? It will be 6 divided by 12. So it will be how much? 0.5. So please compare it with 0.5. Remember one thing. You have return of 3 and how much is your risk free? It is 0.5. So return is more. So don't do anything. This will be 0. If your return is less, then only Morningstar will come into picture. Now 1.75, is it more than 0.5? Yes. Don't do anything. Don't do anything. You have lost first only, and this is 0.5. This will be what? 1.5. This will be 0. This will be 0, and this will be 0. Last how much? This will be 0.5. Always compare with risk free. If your return is more than that, forget it. Don't do anything. If your return is less, you need to compute the risk of loss. Now tell me one thing. How much is the average risk of loss? Please compute. Please compute. 1.5 plus 0.5 divided by 6. This will be 0.333. That is the average. This is the average. Okay. And here 3 plus 1.75 minus 1 plus 3.5 plus 1.5 divided by 6. Here it is 1.46. This is the average. Now do like this for the next two funds also. Manisha, can you explain this once again? Yes, I'll explain. See, in Morningstar model, there are few steps to be followed. The first step is you need to compute the average risk of loss. How to compute that? So for that, you need to compare two columns. See, we have to do this for three things. Fund A, Fund B and the market portfolio at the end. Okay, so I am doing for Fund A. So what I did, I put two columns side by. So first is what? Return, which is there in the question itself. Okay, here. And then risk of loss. So I am comparing risk of loss by risk-free rate. The risk-free rate is given 6%, but that is for 6 months. And the data given in the question is per month. That is why divided by 12, I got what? Per month, that is 0.5. So I am comparing 0.5 risk-free with what? The return. So return, first return is what? 3. So my return is more. I'll do nothing. Is there any loss? There is no loss. 0. Where the return is less, that's where loss will come. Did you get this? Did you get this? Yes or no? Did you get this, Manisha? Yes or no? This. So, add everything, divide by 6. Add everything, divide by 6. So, you will get that. Let me know once you're done. Now, you do it for Fund B. You do it for Fund B and give me the answer. Do it for Fund B. Fund B. This is in front of you. I want the answer first. Do it for Fund B. Everybody. I want the average risk of loss for Fund B and also the average return. And I want your answers from now. I want the comments. After this only go for dinner, not now. I want the answers right away. Do it for Fund B. It's in front of you only. I want Fund B answers. Give me what is risk of loss. And after that, good average, yeah, divide by 6. Niranjan is telling a risk of losses. And Niranjan, no, yeah, the answer is different. No, let others answer. Yes, that is right. Aditya is right. Aditya is right. 0.38 is the answer. 375 and 38. And what is your average return, Aditya? What is your average return? Yes. Niranjan, you need to do it again. Very good. Everybody is right. Please do it for the last one also. So remember one thing, for Fund B, it is the answer is 0.375. That's your average risk of loss, and your average return is 1.25. Very good. Now do it for the last one also. Do it for the market portfolio also. I want the average risk of loss for market portfolio. The last one. Anybody? Anybody? Mayuri 1.25, yes, very good. That is for fund B, right? So what is for the last? What is for market portfolio? Market portfolio, fast. Compare it with 0.5. If it is greater, leave it. If it is less, add it. Simple. Niranjan, yes, you got it right. Please do it for market portfolio, please. I want the answers for market portfolio. There's one answer. We've got one answer coming. Aditya Agarwal, 0.25 for market. And that is exactly right. Very good. Very good. That means you're understanding everything. 0.25 is right. And the return is how much? 1.25. That is very good. That is very, very good. So I'll do one thing. I'll make a summary over here. That is the final thing. Pay attention. Computation of. This is the final summary. Yeah? Computation of Morning Star Index. Morning Star Index. So how to do that? This is known as MSI. MSI. Okay. So particulars. Next your fund A, fund B, and your market portfolio. Market portfolio. Simple. Now tell me one thing. In particulars, you have your average monthly return. How much is that? It was 1.46 for the first. Fund B, how much was it? 1.25 and 1.25 for the market. This is the first column, the average return wala column. Okay. Next, average monthly risk of loss. How much? 0.33, 0.38, like 375, only approximately, and 0.25. And the MSI, the main answer, what you want to tell to the examiner is this Morning Star Index, and that is your 1 minus 2. What is 1 minus 2? This is 1, this is 2, this is 3. 1 minus 2. How much is it? Please tell. 1.46 minus 0.33. 1.13. 1.25 minus 0.38. 0.87. And 1.25 minus 0.25. 1. So what is the final ranking? The final ranking is, this is 1, this is 2, just see how much you got the answer. What? This is your MSI index. So basically your answer is what? Your answer is this only, fund A, MSI. That is the more Morning Star Index. Has everybody got it? Yes, no? Has everybody got it? Yes, no? Please give me an answer fast. Acha, one sec. Somebody asked me something. Aditya Agarwal. It seems that guy is studying. Guys, please wait for 1 minute. He has asked could you also not cover the question of mutual fund marathon. Acha, this is there. No, the farmers net. What is this selectivity? This is there. Give me one second. I'm just finding that question. Write it right now only. I'll give you how to solve that thing. Actually, right now. Write it right now only. Computation of farmers net sensitivity. Please write down. Step number 1. See, even if you write the steps now, it is very simple. Okay. Step number 1. Compute risk premium from portfolio. Well, what is risk premium? You know na, RP minus RF. That's your first step. This is your first step. Step number 2. Everybody write down this. You will not get this anywhere. Write down. This is your first step. RP minus RF. Second step, risk premium from market. Basically, this is your benchmark. That is RM minus RF. This is your step number 2. RM minus RF. This is your step number 1. This is your step number 2. Next, step number 3. Gain from picking the stock. RP minus RF minus beta RM minus RF. And Aditya Agarwal, and who is there? There's one more guy, no? Aditya Agarwal only. See, Aditya, this is there, no? The question, step number 3, that is same as your Jensen's alpha. If you go and check Jensen's alpha, that's the same step. Step 3, and there's one more step. Step number 4. Then it's over. Step 4, that is net gain. And this is RP minus RF minus RM minus RF into standard deviation of portfolio upon standard deviation of market. These 4 steps are there for what? If they ask you pharma question, pharma's net selectivity, pharma's net sensitivity, this is the question. These 4 steps are there. First, compute risk premium, simple RP. Everything will be given in the examination. RP minus RF, RM minus RF, then the Jensen's alpha formula, and last net gain, and then your answer will be there. Aditya is okay? Cool. So please write down this. Okay. I think I call it a day. Okay. Thank you so much, everyone. Thank you for the amazing response. You all were there. That is why this marathon could happen. Share this marathon with all your friends. And also one more thing. There are few things which I already mentioned. The SCA marathon is coming up. Yes, I've got already messages. I'll do it at the earliest as possible. The point is what we have already been packed up with other schedules, because see, our CA foundation, our CA intermediate, our CCIT, our CMA inter is also going on. CS executive just started. So that is why we did not announce first. So let us see how I get time and all. But if it comes, it will come before your exams. That is for sure. Okay. I hope it was a value addition to all of you. But it's a very good thing. Everybody was there till the end. Okay. So thank you so much. If anything is there more, you can just put down the message in the description box number. The notes will be compiled. Give me like today night. Okay. Tomorrow morning, late night, I'll compile everything, and by tomorrow I'll send it across. I have everybody's number, so I'll just send it across. So if your friends wants it, you can just share it to them. Okay. And best of luck for your examinations. You guys are gonna rock the exam. Okay. Please be motivated. Please be confident. See, at the end of the day, what is gonna happen is that
Don't do something very new. Students get demotivated by looking at that. You see, only one thing you need, that is your confidence. If confidence is there, no, there's nothing in this world which is going to stop you. Okay. And remember one more thing, the centers are very far, so please go like one hour before only. And rest, your guys are going to clear, that is for sure. So best of luck once again. Marathons will come, and thank you so much. Okay. What about the theory part? Theory part I'll give it in the notes. Notes for the I'll cover it. Just read that much. That is more than enough. Okay. And one more thing, when you guys clear, don't forget me. Just put a message. Yes, I've cleared. I've got so and so marks. Okay. So thank you so much. Good night and take care.